We would like to continue with the day 2 of the conference. First, as usual, just some boring information from me. The official part lasts until 12:30, but please don't be hurry. We will have a lunch again at the same restaurant as yesterday, and hopefully it will be same very nice food. Not the same, but similarly nice food as yesterday, hopefully. Having said that, I'm very glad that I can welcome you here also for day 2, online as well. And I would like to ask Ernst to introduce our keynote speaker. So thank you very much.
Thank you very much, Jan. Good morning, everybody. I hope you had a pleasant night and a good rest and are ready for today's elaborations. We had thorough discussions yesterday about what we know about macroprudential policies already so far, both from an academic research. If I may summarize roughly, the verdict of the effectiveness was, let's say, mixed. And from a practitioner's perspective, from a policymaker's perspective, there was a more positive perception about effectiveness. In a number of interventions, the limits to our knowledge and to our macroprudential toolbox, and also in terms of implementation, became obvious. The 2 sessions this morning will be devoted to the future of macroprudential policies, what further research is needed, and in which direction macroprudential policy is going in a highly complex and risky world. We start the morning with the first aspect, the 2023 SWERF annual lecture on defining the research frontiers from macroprudential policies, where to go from here. With Professor Thorsten Beck, we have an ideal speaker for this purpose. I'm sure that all of you in the room and also online have heard of Thorsten and have read his impressive body of work. So instead of a long introduction to Thorsten's CV, may I refer you to Thorsten's website, thorstenbeck.com, which I had a look in preparation for this a couple of days ago. Oh, this is really entertaining. This is super stuff. There's a really nice account of your life, which is impressive. You know, so many different stations around the world in different institutions. There's also some private life information, which is always interesting. And there are some very good references about, you know, interesting papers. There's a blog. So it's really worth checking out. Now, what makes Thorsten, who, by the way, is also a SWERF fellow, and we're very honored and pleased about this, what makes Thorsten particularly interesting for this conference is the combination of 3 things. First, rigorous, original, innovative research on finance and financial stability topics. Second, Thorsten's rich experience as a policy advisor for key international institutions. As you know, Thorsten is now co-chair of the Advisory Scientific Committee of the ESRB, a very important body, known to all here in the room. And third, Thorsten is the director of the Florence School of Banking and Finance and professor of financial stability at the European University Institute. In all 3 fields, Thorsten deals on a daily basis with the challenge of defining the research frontier for macroprudential policies. Without further ado, Thorsten, may I invite you to deliver the 2023 SWERF annual lecture.
Well, first of all, thank you very much for this very kind introduction. Now, when I was asked to give this annual lecture, first of all, of course, let me thank the Central Bank of Slovakia for the hospitality that we have been experiencing over the last day and morning. And of course also the Central Bank of Finland for the co-organizing, and the SWERF, of course, for the kind of the 30 years of thought leadership in this space, and to also help bridge the academia and policy world in this space. Now, when I was asked to give this annual lecture, the organizers kindly pointed me to the website with the list of previous speakers, which I know they tried to be helpful. I got a bit scared, I have to admit, a bit nervous, because there were some actually quite quite famous names among them. And my second kind of challenge was, I have lots of slides, by the way, which I will not be able to go all through, but I kept thinking about what is the main message I want to get across. Because you can talk a lot about Macropru, we've talked about it a lot yesterday, a lot looking back, a lot looking forward. I can give a list of lots of research topics that I think is exciting, of new ideas to build databases, a little bit along the lines that Ricardo mentioned yesterday. But what is the main message I want to get across? And it kind of brings us back to a discussion we had yesterday, which also actually Martin Helwig kind of took some very strong stance, and that is, what is it actually? I mean, is it just, if Macropru is everything, it's nothing? Is it, how do we define it? And yes, beyond macroprudential stance, the different tools, policies, the institutional design, the implementation, the political economy, I kind of want to get across the point that it's really an analytical framework, almost like a mindset, of looking for new risks, new fragility in the financial system, and beyond the regulatory perimeter. So being kind of on a constant search and hunt for possible new risks, almost being obsessed about it. And I mean obsessed in a positive sense now. So this is kind of the main message that I want to get across, and you can see over time that I kind of will refer back to this. If I just gave you the job description for the ESRB, that's purely coincidental, by the way. Good. Right. So let me start with kind of a definition, financial stability. We've discussed this before, of course, which again is a very broad one, but basically a condition in which the financial system is resilient, withstands shocks, and withstands the unraveling of financial imbalances. So it's about resilience, and again, this is a very broad definition. There's nothing about credit cycles here. I mean, there's the imbalances, of course. There's nothing about GSIPs, about CCPs. It's a very broad definition. I think that's, again, what I want to get back to later on. Why do we care? And I think when we talk about stability, we'd like to focus on stability, of course, but we should always keep in mind that ultimately stability is just a means to an end. And the end is, of course, we want to avoid damage for the real economy, for firms, for households, for societies. And of course, these, we've seen it in previous crises, these damages have been enormous in terms of, especially of costs, economic costs, social costs, fiscal costs, and so on. And I mean, one defining kind of fundament for the discussion on Macropru is, of course, as the English and the Irish like to say, that it never rains, it always pours. A bank rarely fails by itself, as you can see in the bottom part of the slide, which is the share of failed banks in the US over the existence of the FDIC. You can see the tail end of the Great Depression. You can see the S&L crisis, which also Martin Helwig referred to yesterday. You can see the Great Recession. So there are these peaks. And if you go to the left-hand side on the country level, you can also see that even banking crises kind of, I mean, yes, you have the idiosyncratic banking crisis in one country that doesn't affect any other countries, but they come in bunches together, sometimes geographically concentrated, sometimes, as in 2008-9, on both sides of the Atlantic. So, based on this, what is the objective of Macropru? Again, we talked about this. It's to prevent excessive buildup of risks, smoothen the financial cycle, maybe, but at least make the financial system resilient to the cycle. So this is what most, including what we talked about yesterday in terms of the research, that's what most of the discussion is often about. But there are two other dimensions I want to briefly mention, which is the cross-sectional dimension. make a financial system resilient to the failure of systemically important financial institutions. I mean, one can argue that the fact that Lehman Brothers was let go because the Federal Reserve thought, well, it won't happen, it won't be that bad. Of course, there were lots of other constraints. That was a mistake, and they realized that it was much more connected than they thought. Similarly, the fact that AIG was bailed out, of course, was because it had this critical function in the CDS market. So that's another important dimension. And then finally, more generally, and that brings me back to my initial kind of statement, a system-wide perspective, make the system more resilient to any shocks. So this is more the structural dimension. And of course, when we talk about research, there are different dimensions, different evaluation techniques that we need to use there. Again, let me not talk about that much here. This is, has been discussed. It's kind of this bottom-up versus top-down approach, looking at individual trees versus the forest as such. It also kind of gets back to the fact that, especially in 2008-9 in Europe, in the US, following the global financial crisis, the Great Recession, there was kind of the realization that having just monetary policy, having just microprudential supervision is simply not enough, because these different dimensions, the different policy areas kind of interact with each other. Or to put it more in a historic view, we advanced countries, so-called advanced countries, we actually late to the party of Macropru. Emerging markets, developing economies have been discussing, have been using macroprudential policy tools for much longer. And there, as you can see, I crossed out this word repression. I mean, some of these tools can also be used for repression purposes. I mean, there is a long literature, which professionally speaking, I kind of grew up with on financial repression. I mean, you can think about liquidity requirement, reserve requirements as a prudential tool. You can also think about a tool of capturing certain part of the cash in banks for purposes of direct lending by the central bank or by development banks. So there are, some of these tools have two sides to it. Of course, here in the advanced countries, similarly after World War II, there were tools to kind of make sure that the government debt was brought down with keeping interest rates artificially low, and to, of course, also to kind of avoid capital flows, to avoid that kind of these flows would endanger the government solvency positions. So there's this important point, something I'm going to come back to at a later stage. The global financial crisis kind of made clear, again, that this distinction between inflation targeting on the one hand and making sure that each financial institution by itself is stable is not sufficient. We know by now, there has been a long literature on that monetary policy does have an influence on financial stability through the so-called risk-taking channel of monetary policy. There's lots of theory on this, lots of empirical work, but then also that financial instability can force the hand of the monetary policy authorities, something that the Bank of England, for example, found out the hard way, of course, last September during the 49 days of Liz Truss. Now, fast forward, so there was then the approach to include macroprudential tools, including in Basel III. The pandemic actually kind of brought this back to the forefront with some additional measures of Macropru, which I am also going to briefly talk about, which is the capital release and the dividend restrictions. Now, so there was discussion yesterday, where does micro end, where does macro start? And I mean, it's hard to tell. For example, if again, talk about the dividend restriction in 2020, it was the SSM who actually first came out and told the significant institutions in the euro area to not pay out dividends. And then the ESRB followed afterwards, a couple of weeks, months later, with a similar recommendation, which went to all of the national designated authorities, the competent authorities, in terms of payout restrictions. So there is clearly an overlap. There's also an institutional overlap, obviously. But so that's why I'm saying again, maybe it's not about just trying to get stuck in the definitional issues, but more about the analytical approach. So something also, I mean, I mentioned this already earlier, what is Macropru? The sky is the limit. This is out of a paper, I think it's an IMF paper which involved probably Eugenio Cerruti and probably Stein Klaassen. The Macroprudential Toolkit, as you can see, actually, I mean, the kind of the core looks familiar, but if you go further to the right, further down, you get to taxes, levies, then you get to accounting. Actually, I did mention this yesterday when Martin Helwig talked about accounting standards recognizing non-materialized losses in the HDM book. OTCs, CCPs, bank resolution. I mean, it's still the same. The title still says, the table title still says Macroprudential Toolkit. So it's a very, it's everything and nothing. You can almost argue. And again, the underlying purpose being making the financial system more resilient. So all of these policies are in there, right? Again, so it's a very broad mandate you can ask. But of course, when we then go back to the legal framework, that's of course, the regulatory framework, that's of course when it's much more fine-tuned. So let me briefly talk about the empirical challenges, because that's also, I mean, that's something that Ricardo already referred to, but just to bring them again up on the forefront. So we have a big problem gauging the effect of macroprudential tools on different outcome variables, such as credit growth, asset growth, risk-taking by banks, borrowers' access to funding, households' access to funding. Number one, of course, is the endogeneity problem, which we economists love to obsess about. Again, this time I don't say it in a positive way, more in a neutral way. I think it's an important point. Because we know, of course, that macroprudential policy tools don't come out of nowhere. They are a reaction to macrofinancial development. So they are clearly not, they're not exogenous shocks. There's demand, there are supply channels, and of course, there are also other policy measures. I mean, again, think about March 2020. It wasn't just capital release, it wasn't just dividend restrictions, it was monetary policy easing, there was fiscal support. There were lots of things going on at the same time. So kind of isolate the effect of Macropru might be difficult. I mean, I would say I'm a bit skeptical that we can overcome this in a macro, in a cross-country setting, also because, as Ricardo pointed out yesterday, the data that we have on macroprudential tools, making them comparable across countries, does involve lots of compromises. So we work with dummy variables, we work with +1, -1, but I mean, we made a lot of progress, and I'm not trying to downplay this work, but I think we have to also recognize the limitations. That's why we like to go to microdata, borrower-level data, combining credit registry with corporate registry, or even like in the case of Bank de Spain, available loan application. So you can really isolate the supply effect. You can look at the extensive margin, the intensive margins of borrowers gaining, losing access, or the volume of lending, price effects, quality effects, also risk-taking effects. So this is kind of where we'd like to go in terms of assessing the impact of Macropru. Often, we still have the exogeneity issue, but we can use the differences across different banks, different borrowers, maybe geographic areas, some of them being affected, others not by the Macropru policies, or below, above a certain threshold. We can use that to identify the effect. There is still the problem. There is anticipation. I mean, yesterday we talked about the countercyclical buffer is being, changes in the countercyclical buffer, at least upwards, are being announced a year ahead. Do we look at the announcement effect or the implementation effect? And here, I guess, when we talk about assessment of Macropru, we are not there yet where the monetary policy evaluation is, because they have learned how to isolate the surprise effect by looking at these 30 minutes after the press conference or the press release of monetary policy decisions. So we are far away from that. There is the issue also mentioned yesterday by Ricardo, external versus internal validity. On the one hand, yes, by looking at broad cross-country panel data, yes, we can kind of make statements about what works, what doesn't in a broad context, but it's not as well identified, whereas if we look at one specific policy, change in LTV ratio, change in countercyclical capital buffers, and there has been lots of good studies on that, that's for one country. Can we really infer from Canada to France, to Italy, from Denmark to Germany? Very different financial structure. So that's definitely a challenge. Now, this has been partly overcome by, as Ricardo mentioned yesterday, by the IBRN, the International Banking Research Network, which kind of gives kind of looks at similar challenges, or sorry, similar policy changes across different countries, looking at microdata from different countries, and then kind of trying to synthesize the results from different countries. So I think that's definitely a very promising way forward. The overlap, I mean, we've just been, also with Stefan and with Tomas, we've been discussing this again outside over coffee right before this, this session. There is, of course, the question of should these decisions be taken completely independent, which typically we like to think about this during normal times. During crisis times, not necessarily. I mean, for me, the best example was the joint announcement by the Bank of England, the 3 committees that they have, and the monetary, financial, and the prudential one, kind of sending a signal that the authorities together stand ready to support. Of course, there is beyond the conflict, the overlap, again, with monetary policies, do they go in the same direction as we had it before the pandemic and during the pandemic, or do they go possibly in different directions as we now have maybe with monetary tightening? There is, of course, the overlap with fiscal policy. I'm going to come back to this later when I talk about the politics. There might be also the competition issue, level playing field. Why do we have some banks have to hold more capital than others? How do we go about challenger banks coming in but not having the data to run internal risk models? Consumer protection policy. There are lots of other areas, and this is a little bit what also Martin, I guess, referred to yesterday, that there is, where does Macropru fit in? It overlaps with lots of other policy areas. So what have we learned? Again, this is something, by the way, there's an excellent Swerve note I would like to mention. Is it Paulo Duarte from Banco do Portugal, I think? Can highly recommend it. 4 or 5 pages to kind of summarize what we've learned. And so Ricardo mentioned it, of course, yesterday as well. Macropru can be successful if it is binding, probably more so in the upturn, so kind of preventing excessive risk-taking, not so much in the downturn. There is the continuous challenge of leakages, and of course that varies across financial systems according to how open they are. And it can be not just foreign branches, that's what we like to think about. It can be NBFI, but it can be also, for example, fintech, it can be big tech. So it can be other institutions outside the regulatory parameter. Important differential effects across firms, across households, but also something I'm going to come back to later again, distributional effects. Smaller firms, and I have a paper from a couple of years ago on that, smaller firms being more affected than larger firms. But maybe smaller firms are in the tightening cycle. Maybe smaller firms are riskier. Maybe we do want to exclude them when we tighten the capital requirements or the loan-to-value ratios. But at least we have to also recognize these effects. And we also learned, of course, yesterday that the actual measures are not necessarily the optimal as coming out of the quantitative models that both Enrique and Javier mentioned yesterday. Now, the pandemic 2020 has brought kind of yet another round of kind of new macroprudential tools, well, not necessarily new tools. Although the dividend restriction, I think it is kind of a new tool, although at least from the ESRB side, and I think also from the SSM side, it wasn't actually a hard tool, it was more like a soft tool. Release of capital, and then of course we found out that especially in the euro area, I mean, if your countercyclical capital buffer is at 0, you can't release it. So it was kind of, there was this kind of in hindsight mistake of not having built it up beforehand. And it kind of course also back to the politics again that Martin mentioned yesterday. But there was beyond, of course, the countercyclical capital buffer on the national level, there was from the SSM side, the conservation buffer, the Pillar 2 kind of release. Basically, the idea being support lending to the real economy. Now, of course, as we already discussed yesterday, the pandemic wasn't really a financial crisis. It was a very different type of animal. And maybe we don't necessarily expect the release of these capital buffers to work the same way as they would in a downturn that is at least partly coming from the financial sector. It's important, however, when we kind of assess the success or non-success of these capital releases, to look at the counterfactual. What if they had not been released? So it's not about did these capital releases directly translate into additional lending one by one, but what would have happened, which we don't know, if they had not been released. From this viewpoint, probably it was at least partly a success. Of course, we also understand that banks might have been reluctant to release all of their capital buffers in terms of signaling to investors, knowing that they will be reversed in the future, maybe also to kind of take care, and we had this discussion, of course, in the early days or in 2020, for future losses, which ultimately didn't materialize, but there was a big kind of scare in 2020. What would come up for the what would be ahead for the financial system after the end of the pandemic? Dividend restrictions, they are obviously, I'm a bit biased because I was involved in that work, but again, the idea very similar: preserve capital and giving all of the support by fiscal monetary authorities to prevent basically risk shifting. So basically allowing the banks to just pay out more in dividends what they saved on the other side. There have been actually an amazing number of studies very early on, and I'm glad that they kind of pointed to the same direction, that this has been actually successful. And there is actually a paper that was that won, I think, last year's Jecke van den Burg Prize, which showed that these dividend restrictions lowered equity and increased debt prices. So there was equity holders lost versus vis-a-vis the debt holders of the banks. And there was also more lending. And that was actually, it referred to the US, because in the US you had these differential effects. Not all of them were affected by the dividend restriction. Or in this case, actually, it was buyback restriction. There weren't dividend restrictions. But so overall, it seemed to have been successful, these dividend restrictions in terms of what when the regulators try to achieve with them. The question, of course, and again, I'm going to come back to the later stage, sorry, I keep promising. The question is, should that tool be a permanent part of the toolbox, or do we really leave it for extreme situations? Something I'm going to touch upon briefly later on. So, maybe I shouldn't talk too much about this. I mean, there is the issue of the institutional setup, which again, there's a clear difference between monetary policy and prudential, macroprudential, micro and macroprudential, in terms of that we don't really have a clear-cut goal. I mean, we don't have an inflation target. When we're successful, it's not being reported, because if there's stability, then this is boring to report. And of course, also, what is the counterfactual? If there's no turmoil in financial markets, if there's no bank failure, is it we're just lucky, no macro shocks, or is it actually that regulators are doing a good job? So there is this issue. There is, of course, also the independence, and I mean that's, by the way, a strong argument in favor of having prudential, especially also macroprudential, in the central bank, because typically they are more independent and prudential authorities. Again, I can see this in my own country, BaFin versus the Bundesbank, for example. But of course, there's also the issue of accountability to ultimately Parliament and the taxpayer. That is a part maybe I should skip. There is actually some work we've done, I participated in at a discussion paper at the ECB research group, where we kind of looked at, should monetary policy and prudential policy actually be in the same institution or not. We have different models in Europe. But we found, and we're careful because, again, this is not very well identified. We're careful to at least say, well, there's no evidence that an integrated structure, as some claim, leads to more instability. If at all, it might actually go the other way. And again, I'm not saying this in the sense that we should all adopt the same kind of structure, but at least it can lead to more stability if you have everything in the same house. The question, of course, again, being, do you need Chinese walls between supervision and monetary policy? What is the degree of coordination going on between them? One interesting thing that we found in this work is that actually one reason why it might be good to have in the same place, same institution, is that authorities are more likely, central banks are more likely to use macroprudential tools in a credit boom if they also have macroprudential power, than if the macroprudential power is outside the central bank. So there seems to be some kind of benefit of coordination. Good. Politics. Taking away the punch ball. Nobody likes doing that. Does an independent supervisor always help, especially or a central banker, especially if she is up for reappointment? I mean, there's a lot of discussion on that. I mean, I like to believe that, yes, as Stefan also said yesterday, I mean, that institutional independence does help. But there is, of course, lots of pressure. So a PhD student of mine, actually in political science, Etienne Lepers, kind of looked into this in more detail in his thesis. And we've heard examples yesterday already. What I put up here are examples from Ireland he looked more closely in. And it's interesting in terms of both the limited memory, but also kind of the political pressure on the central banks that comes from lots of different sides, from the media, from the Ministry of Finance, in terms of, no, you're not going to put up, you're not going to reduce the loan-to-value ratio, you're not going to tighten access to housing credit because the young people need housing. I mean, that's an important discussion, right? So there is, and of course the Central Bank of Ireland is independent, but there, as you can see, there is lots of political pressure. And there's of course also lots of potential conflict with fiscal policy and political objectives. Let's help young people to get on the housing ladder, as they call it. Well, how do we do this? We reduce the stamp duty, for example. We give additional cheap loans from a government bank. Well, of course, that goes against any tendency by the central bank to kind of try to tighten a credit access in a boom period. I think Stefan mentioned some of this yesterday, if not in a dinner speech, at least over coffee with Sweden being a similar example of that. So that is, again, it's an important question that we cannot ignore. And of course, borrower-based measures, of course, are the ones that are most open to such political pressure, because they are also easiest to understand for the overall electorate and population. There's an important cross-border dimension I want to briefly mention. We know, of course, from lots of work that there is the domestic financial cycles are being driven by the global financial crisis. We kind of, based on work by Helen Ray and co-authors, we kind of moved from the idea of a trilemma to a dilemma, that even with fixed or flexible exchange rate, you don't really have complete monetary policy independence if you leave your capital account open. But there's also increasing evidence that macroprudential tools can, in the host country, can actually help, in emerging markets can actually help, kind of mitigate a little bit this impact of the global financial cycle on domestic financial cycles. There is obviously something to take into account, and maybe I'll come back to this when I talk about Europe later on, in terms of outbound and inbound spillover effects of macroprudential policies in the own country affecting other countries, but also the own financial institutions being affected by macroprudential policy decisions being taken in foreign countries. And yes, so Stefan mentioned yesterday reciprocity, always a difficult word for me, which has a messy concept, but of course it might not, it's on the counter-cyclical capital buffer, as I understand, but not necessarily on other macroprudential tools. So there's something definitely to take into account. And of course also in terms of research agenda, something that I think much more work is to be expected. That's of course the question again. Let me come back to the ESRB very quickly. We have of course the monetary union. We have now macroprudential on the euro area level, euro area +1. What about the macropru? There are arguments being made that actually no, of course macroprudential tools should be on the policy tools should be implemented on the national level, but there is at least at a minimum coordination being required. And some people would even argue for more to avoid these spillover effects coming from a credit boom in Spain and Ireland for the rest of the euro area, or these countries going into a financial instability situation, which ultimately burdens the overall currency union. So how do we understand that? And of course, and again, I'm not going to talk more about this given my own function in the structure of the ESRB, there is an important, of course, role for the ESRB, which currently is on the soft power. But again, some are asking for more. Don't want to go into this debate, but it's at least an open question. So, let me come to my last couple of slides, and this is actually the part that relates directly to the title, looking forward. What is the research agenda, as I see it? Now, as I mentioned earlier, we've been talking a lot about this time series dimension, about financial cycles, how to smoothen them and how to make the financial system, how to make financial institutions more resilient against the cycle or shocks that might exacerbate the cycle. But of course, there are two other dimensions, as I mentioned earlier. There's the cross-sectional dimension. There was this BIS report, which I think was still before the pandemic, under the leadership of Claudia Buch, on too big to fail. Have we solved too big to fail? Well, I think as Credit Suisse tells us, probably not. The question is, are we picking always the right institutions for too big to fail? When SVB failed, it seemed like a clear-cut case. I mean, it's a mid-sized bank. It wasn't under the significant institutions. It would have been resolved, right? Write off depositors, shut it down, and then soon authorities realized, well, maybe it's more important for all kind of reasons than we had envisioned. And of course, this tells us again that they maybe should have intervened much earlier or should have supervised much more carefully. So do we always choose the right institution? Do we always see the right institution as the systemically important ones? There's the structural ones, for example, CCPs have to become more resilient. What about resolution frameworks? It gets me back to this earlier slide where I showed you all of this toolkit and the sky is the limit. Of course, again, from research viewpoint, these questions demand different techniques. I mean, there has been some work on whether too big to fail has been addressed. I guess the answer is to a certain extent, yes. So the funding advantage of systemically important institution has somewhat come down, but not. It hasn't been completely eliminated. And yes, the introducing bail-in can actually also is being reflected also in the prices of bail-inable debt, for example. So there has been some work ongoing, but I think there's much more to be done. Now, bringing me back to the issue of this much broader question, beyond kind of specific kind of balance sheet tools, if I may say so, or capital requirements, for example, maybe liquidity requirements, there are also issues on the financial institution level which capital buffers might not be sufficient for. Cyber attacks, geopolitical tensions, risks turning into disasters, which is not really, you can't really buffer for it unless you want to have a capital buffer of 100%. But maybe you need crisis management plans, business continuation plans, similar like what was developed after 9/11, for example. So this is, of course, you could argue completely outside what we like to think about macro-pru, but I think actually when we think about risk and fragility, that is actually also part of it, I would argue. Methods. Economists love to talk about what is the ideal method. So I've been a bit part of the discussion in development economics, randomized control trials being the gold standard, supposedly. We've heard a little bit yesterday about different methods. My view is it's all of the above. I think all of these have very important roles to play. On the one hand, what Ricardo presented a little bit yesterday, looking at specific instruments, policies, hopefully with microdata, regression analysis, of course only with one eye, not two. And yes, can we look beyond the trees in one country? Yes, we can, through the IBIN and similar initiatives. I think the BIS has a similar initiative now, for example, through the Latin America office. But of course also looking at macroprudential policy stance, the forest. So this is what Javier and Enrique talked about yesterday, the more the structural, the quantitative models. I would make a strong case, although I'm not a theorist myself, I would make a strong case that also theory, pure theory, not quantifiable, but pure theory can be very useful. I mean, just last week, and coming back to the question on dividend restrictions, I read, 2 weeks ago, I read a very interesting paper that made the point that no, dividend restrictions should not be part of the permanent policy toolkit. Why? Because if banks know or anticipate that they will be subject to dividend restrictions in a downturn, they might hold less excess capital, or they might pay out more dividends in advance of the restriction. Now you can say, well, I don't need a theory model for this argument, but sometimes it's good to have a theory model just to kind of make a certain argument in a rigorous way. And in this case, since we don't have any data, we don't have any experience, I think that's, for example, a very useful contribution. Other examples include the role of information. How much information should a supervisor share? How much discretion should a supervisor have, for example, in the case of crises in terms of resolution? Should her hands be tied in terms of bail-in, or should it actually have some flexibility? There's evidence or there's theory that suggests that no, it's actually they should have some flexibility. Of course, I talked already about leakages, spillovers, and regulatory arbitrage. Research agenda, you never walk alone. We've talked about yesterday a little bit the interaction between macroeconomists or monetary economists and financial economists, and I think a lot has been discussed over the last 15 years. But there's also the fiscal policy, of course, and I mean we are in a different situation now than we were. I mean, if you want to talk about a previous tightening cycle than in any previous tightening cycle, or in the loosening cycle, in terms of supply side constraints, political constraints, or how much can we actually learn from previous cycles for the current one, given the different circumstances. So to which extent do we have to take this also into account, and how do we actually model it? Now, since 2 years now, I've been part of an interdisciplinary center at the UI. I'm also director of the, as mentioned by Ernest, of a interdisciplinary school. And so it makes me appreciate now much more how much we economists, and I include both macro and financial economists, can learn from other disciplines, including political science, in terms of the political economy, but also institutional design. Committee decisions versus only decisions by one institution or by one person. So there's a lot to be learned there, and obviously the law and regulation, that's I think always underappreciated. When I got involved in the work on the ESRB, I kind of really learned to appreciate the help from the lawyers. Where are all the trees? And now I get actually back to what I started out with. We know that coming from a much lower level than the US, there has been a move towards non-bank financial intermediation, what we used to call the shadow banking, which of course creates new possible sources of risks. There has been a discussion on the on the crypto assets, cryptocurrencies, although at least, I mean, what and we at the ESRB we've been discussing, it doesn't seem to be as worrisome as it might be or might become. But of course, so this is the kind of the permanent search for new sources of regulatory arbitrage, risk shifting outside the regulatory perimeter, or new risks emerging. Liquidity risks are being discussed, of course, also in the wake of the of Credit Suisse, of the US banking crisis, bank failures, and the much more rapid deposit withdrawals runs that than we observed earlier. Climate risk, just another macro risk, and but also the question. I mean, now I'm looking at Gonzalo, because you've been involved in this discussion in a very interesting debate that we had. Well, yes, we might need higher capital buffers, but also we need the banks to fund transition to the net zero economy. So there's a more general issue which I actually kind of pick up on the very bottom here. There is a trade-off we should, and then I know that Enrique also referred to this yesterday. There's a trade-off between stability and also maybe reducing investment, reducing growth, reducing the necessary transition. Yes, there is peace and quiet on the graveyard. We don't want that. But so there is a reason why stability is not a goal in itself. It is for a goal, for an objective to sustain a effective and financial system that supports society. And then finally, and again, this brings me back to my initial point, are we always focusing on the right institutions? So with digitalization, with back office functions being outsourced into the cloud, into platforms, are there being new kind of systemically institutions being created? Not financial institutions, but providers, systemically important providers, that if they fail, all hell will break loose because the system fails. So that's a question. Again, that's what I mean by looking for risks, for new risks popping up. In this case, not being risk shifted, being kind of unintended consequences of financial institutions becoming more efficient through digitalization. So let me finish up on 3 open questions, 3 almost philosophical questions, if I may. I hope there's no philosopher in the room. So one thing that we talked about yesterday already, and this is kind of, again, comes back to theory, empirical, actual, real world. And that's discussion we've had after the global financial crisis. On the one hand, yes, we want to have carefully calibrated policy tools that, that kind of influence the risk-taking incentives of financial market participants, of financial institutions. And of course, for us researchers, it's great stuff. We can work on that. We can really contribute to that. But of course, we also know they can be manipulated, the open arbitrage possibilities, and so on. And can we really fine-tune them sufficiently? Versus the kind of crude, the kind of the hammer approach, leverage ratio, which at least is binding. We know that. But of course, it doesn't really capture the risk, and it doesn't really get into the kind of the little details, the granular thing. The other thing, and again, this brings me back for the new risks. I mean, it's kind of a permanent cat-mouse game, right? There's still this, I used to sometimes show this little cartoon where one banker tells the other, this regulatory reform will definitely change the way we will get around it. So how can regulator supervisors get ahead of market participants in regulatory arbitrage? How can it be? I mean, financial market participants always seem to be a step ahead. How can we avoid that? How can we get ahead of them? And then the final question, this is now really philosophical. I mean, this is kind of for all of us in this room. I mean, there has been a populist backlash after the global financial crisis, but also more generally about the guys in Brussels, the guys in Frankfurt, the technocrats, right? So monetary policy was given to independent institutions, the central banks, independent central banks, because we learned about the time inconsistency. Now, prudential supervision should also be in the independent and shouldn't be under any direct influence of the politicians. Similarly, macroprudential. There are very good reasons for that, very obviously. But of course, it gives kind of an increasing impression on the electorate that they can't influence anything because obviously technocrat decides. What's the next step? Fiscal policy? And of course, additionally to that, at the same time, at least within the euro area, partly within the EU, many of these decisions are not being anymore on the national level, but on the supranational level, on the euro area or the EU level. I mean, the ECB is seen as much more independent than even the Bundesbank. So this is kind of creating this increasing distance, and what, at least from some people, kind of is seen as lack of accountability. That's an open question. How do we address this as technocrats? Should we really rule, and to which extent are we accountable to both politicians but also to the electorate at large? So let me stop here. Thank you very much.
Thank you very much, Torsten, for this excellent overview. I'm sure your last 5 slides fill the research agenda for dozens or even hundreds of economists at universities and policy institutions for the coming decade. I'm sure that your points, not least the 3 last points that we saw last, but also the research agenda and your overall presentation triggers many questions and comments from the audience. Yes, let's start here, please.
Thank you very much, Thorsten. This was a beautiful lecture. I really, really enjoyed it. I guess I will definitely not let the technocrats rule. If I may play devil's advocate for a little bit, maybe could you speak a little bit to the things we haven't learned? And let me explain why. I fully agree with the empirical and the theoretical case for macroprudential regulation. I mean, there's no question about that. But something we talked about yesterday caught my attention. We said that the worst thing we could do is to do nothing. And I think one of the lessons that I learned from the things we have researched, or some of the things Javier has done too, is that it's actually possible that you can do worse than doing nothing. And it's a little bit like the motto in medicine about first do no harm. And it's true that you start from no policy in these quantifiable models. You start from no policy. Introducing the policy is a great thing. It improves efficiency. It improves financial stability. It was like I was talking about yesterday. Reduces the frequency of crisis, reduces the magnitude of crisis. It increases social welfare. It does beautiful things. But then it sort of maxes out pretty quickly. And when it starts to decline, the decline in all these benefits is very rapidly. And there are levels of the policy instruments, again, in the quantifiable models, at which they're not that far above the optimal levels, in which all these things turn negative. And you end up worse than if you had done nothing. And so I wonder if you look more at the level of the firms, it gets worse, because you were talking about this research of yours, which I really like as well, that you often find the smaller firms are affected worse. And sometimes when you dig deeper, as we did in the case of Chile, it turns out this could have been high productivity, promising young, small firms that are asphyxiated by the implementation of policies in some situations. So I wonder if there is an example where you could say maybe in this case there was too much regulation or we didn't do enough. I think, I mean, I love all this stuff and I enjoy very much the conversations from yesterday and today about the use of the policy here and there and how many great things we have done. But I also worry about the risk that maybe in some situations, maybe we have done too much. And I wonder if you could speak to that.
May I link up to that question? You mentioned cross-border spillovers as a quite important field of research recently. So spillovers of macroprudential policies. But of course, you also need to look at the reverse side, spillovers of lack of macroprudential policies. Are there further questions? Yes, please.
Again, fantastic presentation, Thorsten. I wanted to push you a little bit on the macroprudential toolkit boundaries. So like 6-7 years ago, when we were starting to discuss this macroprudential toolkit in a more holistic way, we were trying to learn a lot of lessons from emerging markets, especially from Asia, where they have a very holistic approach to macroprudential. And one of the things that they were discussing is that some of these tools that we're using right now, like LTVs, can only help you to prevent, for example, house price imbalances and things like that. But at the end, if the constraint is on the supply side, you need to build more housing. So they had like this holistic approach where you would incorporate like permit licensing and things like that, so that you could build more houses, so that you can alleviate those constraints on the house price side. So the LTVs can take you so far as to try to limit the house price growth a little bit, but if you don't build more houses, then you have an issue. So where's the boundaries, right? Because now we're talking about intervening in the economy to provide more housing. So what should be the boundaries for macroprudential in this case?
It's a very valid point. So we should include house building policies in your big table from the IMF. We had a question here, please.
Thanks, Thorsten, for the excellent presentation. I really agree with whatever you discuss. And I'm glad that you discuss another issue that we haven't touched on yesterday about political pressures. And this, brings me to a recent paper, in the Journal of Finance by Gocharov, Ioannidou, and Schwartz, University of Lancaster, Bayes University, and University of Oxford, if you are aware of. And what these researchers showed is 2023 has just been published. What they show is that central banks manage earnings. So actually, up to now, we talk about external factors, pandemic, we talk about Russia and Ukraine war, but we may have to take into consideration more additional risks that are coming within the central banks. And this study examined the last 23 years, starting 1992, for 155 national banks globally. So actually they cover, most banks globally. And what they show is that central banks manage their earnings, and this management takes place mainly when there is time for the appointment of the new governor or the governor. So actually the new governor, possibly because he or she has more power, is trying to manage earnings. And you talk about additional risks that we may have to take into consideration in the future. Food for thought, you are much more expert than me as far as the specific issue is concerned. So they talk about agency problems, and these agency problems that they exist, lead to earnings management. So possibly governance issues on behalf of the national banks may be an important factor or an important risk to take into consideration. Because up to this specific point, what we are doing is the following. We want to see market risk, operational risk, governance risk of those banks that we regulate. Maybe time, as you have mentioned, to pay attention to risks that we are facing. And one of the risks that we are facing is, among other things that it just came to my mind, is the following. For example, do governors in some countries have so much power that they decide by themselves? Are they narcissists? So they make decisions by themselves and they don't pay much attention. So actually, ECB or, the regulators, they may have to pay more attention. Because as far as I know, in several national banks, the governor is also the chairman of the board. But we ask those banks that we regulate as national banks that we have to have duality, right? But we don't have duality. Isn't that risk?
Okay, thank you very much.
Thank you.
I think this collection of questions fills another hour. You do the impossible and answer within 5 minutes or so. Thank you.
Okay. I need this microphone, I think. Sorry. Well, thank you very much for all of these very good comments. Let me try to go one by one. So, yes, so Enrique, I think, yes, do no harm. And I also take the point on declining benefits of trying to fine-tune more and more. Have we done too much at some point? I mean, I was thinking now whether I have a specific example. I mean, there might be examples. For the moment, I cannot think about one. Of course, it's always the counterfactual, right? I mean, as you mentioned in the case of Chile, yes, we saw that there was no fragility arising. Would have no fragility arisen also without these tools, for example? Or did we actually undermine growth? So these are very good questions. I don't have an easy answer for that. I think pure empirical analysis is probably not sufficient, so I think your models are probably more helpful in this context, or the combination of both, or calibrated models. But I think I take your point very well. What we haven't learned, and I guess this comes back to the main message I want to get across, is that it's not about what we haven't learned or what we don't know yet. Where will the next crisis come from? Well, obviously, I don't know. You don't know, probably either. But so this is this permanent hunt for new possible sources of fragility. So even if we know everything, we can perfectly explain the last crisis, this helps us only to a certain extent for the next crisis. I mean, I guess I'm stating the obvious here, but so I think that's what I kind of see as a challenge. Not necessarily always looking backwards, trying to further fine-tune the lessons from the last crisis, but more like looking forward. What can we see as upcoming risks? And yes, Ernest, I mean, it's not just macroprudential spillovers, but it's also the lack. And again, I was actually referring to both Spain and Ireland, and that, yes, that of course did have negative. It wasn't, in this case, it wasn't like the necessarily, or might have been also, spillovers for the financial systems in the rest of the euro area. But of course, it did create imbalances, which ultimately had to be resolved within the banking, within the currency union, but without having the banking union quite yet. So that definitely is a good example for that. On Ricardo's point, the macroprudential toolkit, yes, I mean, I guess this comes back to my very last point, right? Should technocrats rule? I mean, where do we draw the line? And I think that's more the issue of central banks. And I know in the US they have a prominent role in that, looking beyond the financial sector and looking at other areas. I mean, that's why also Federal Reserve banks typically have researchers in labor economics, in international economics, and God knows what, not just monetary and financial economics. And I think there the more the role of central banks kind of stepping up and saying, oh, by the way, whatever we do is not going to be sufficient. You guys in the government have also do your part. I think that's going to be the role. But I definitely don't want to put house building on the macroprudential toolkit list. Then finally, I think it was Andreas, right? Number one, I know this paper actually relatively well. I know two of the authors relatively well, and I think it's a great paper. So earning management by central banks, that's kind of a new thing, but that's and I think you put the finger on the right issue. There is an issue of central bank governance. There is an issue of single decision taker versus committee decision taker. And I think actually the Bank of England, I mean, that's one of the reasons they changed their structure after the global financial crisis, to kind of reduce the power of the governor somewhat and put committees in place with partly overlapping, but also in these different policy areas and partly overlapping. There is, of course, then the question, well, if reappointment pressure has implications for central bank actions, should there be a reappointment at all? Or should we, like in the case of the ECB, just go for 8-year terms, non-renewable? I mean, that's a question that, it's an open question, but I think these are points very well taken. Thanks.
Thank you very much. This brings us to the end of the 2023 SWERF annual lecture on defining the research frontiers for macroprudential policies, where to go from here. Thank you, Torsten, for your excellent overview and for sketching in which direction our further efforts to refine and develop macroprudential policy research and policy should go. Thank you to all of you for your excellent questions and to you for trying to answer them in such a brief way. We now have a coffee break. Try to be back at 10:45, please. Thank you very much.
So, dear ladies and gentlemen, welcome back to our last session. So, if you ever wondered what will be the future of the macroprudential policy, now you will get to know everything. And right after the session, please prepare your notes, because Rainer will examine you about the content of this 1.5 day. So, please enjoy. And now I give the floor to the chair of the next session, Markus. So, please, the floor is yours.
Thank you very much. Actually, I don't need the microphone. Let me thank also the organizers of this conference for inviting us all here. I think it has been a great experience so far, and I hope we can provide a good last session to you. I'd like to start with a quote from Albert Einstein, who said, he never looks into the future because it comes soon enough. We are obviously not as wise as Einstein was, and that's why we try to, at least for the macroprudential side of it. I think it's fair to say that after COVID-19, we now know that the macroprudential ship is a lot more storm-proof than it used to be 10, 15, 20 years ago. But I think it would be short-sighted to say that we should stop at this juncture. There are a number of issues we need to discuss, and I think Thorsten had a wonderful tour de table, so to say, of what are these issues that need to be addressed, and I think that's where we are now in more detail going to follow up on. But the issues are, of course, on the table on how to deploy the current tools we have in the right way, given the side effects that we had from the ultra-loose monetary policies over the last decade, given the rapid rise of interest rates, a story that also from a macroprudential perspective is certainly not over yet. And then there are the more structural issues in terms also of how to integrate non-financial risk. Thorsten has talked about cyber risk, digitalization. Climate risk is going to be a big topic of this panel. And of course, there is the issue of the need to look, and I think this has been a topic already yesterday, beyond the banking sector. As the non-bank sector has grown in importance, do we need to extend our toolset to non-banks? So the issue really is there a need for a more holistic picture for macroprudential policy? And if your answer is yes, how do we actually avoid overburdening macroprudential policy? Let alone avoid emission drift, because there are a lot of overlaps with other policy areas that we need to take into account. In other words, making reference to the title of the session, how do we actually avoid ending up in a Huxley-style dystopian future, Brave New World, but how can we implement macroprudential policy in a way that actually fosters financial stability? And I'm here to discuss this with a distinguished panel. I have Christina Celler, to start with you first, who is an advisor in the Swedish Central Bank working in the research department. Christina is an expert on non-banks. That's going to be her main topic today. We have Thomas, who is going to start off giving us, I think, a broad picture in terms of where all the construction work needs to happen. We have Paul, who is head of the, let me try to get this right, the Systemic Risk and Financial Institutions Division at the ECB. Paul is going to focus on climate risk. And last but not least, we are very happy not to be an insiders club, so to say, but to also get an industry perspective. And I invite Gonzalo, who is the Senior Director for Prudential Policy and Supervision at the European Banking Federation, to take an explicitly critical view of macroprudential policy, because I think it is only by also hearing the other side of banks, non-banks, whoever is the addressee of our policies, that we can move forward in a constructive way. And without further ado, I would ask Thomas to start with his intervention.
Okay, ladies and gentlemen, I would like to first thank the organizers for this event. It has been a truly insightful and pleasant conference, one of the best I have ever attended to on macroprudential policy. I would like to also make the point on the usual disclaimer that my views might be not reflecting the general board of the ESRB's view, but rather my own views. So let's start. Next slide, please. Okay, so sorry for the technical hiccup. So I think we can all agree, and that was very clear from yesterday and today's talk, that since the global financial crisis, the regulatory framework has clearly developed to the right direction. We have been able to make the financial system more resilient. We have seen the shocks of the COVID, also all the policy actions that were in a broad sense macroprudential helped to maintain that the human tragedy and the health crisis didn't spill over to the financial crisis. But we all also should agree that the road is not complete. There are many reforms, there are many issues that should be implemented. One of them is the Basel III, and of course also other initiatives on the banking union, the capital markets union, that I hope would one day be further strengthening the EU financial system. So one of the key topics has been here, what is macroprudential policy? And I liked very much Thorsten Beck's nice comparison for the pertinent quest to detect systemic risk and then to use the broad set of tools possible to mitigate that and prevent the systemic risk to materialize. So this is what I think is the broad sense of macroprudential policy. But we, of course, also have the narrow sense of macroprudential policy, so looking really the particular instruments that are available in the EU legislation to the macroprudential authorities. And I want to make the point that the macroprudential policy is active currently in Europe. It's not the case in all parts of the world. But in Europe, it is active. We have seen, for instance, since the COVID crisis, lots of actions were taken to mitigate, to release the buffers that were there, as mentioned. There could have been more buffers to be released, but those who had released. But there has been also then actions to start building up the resilience. And I personally think that the counter-cyclical capital buffer is there really to increase resilience rather than to mitigate the financial cycle. But we also see that there are still some, so the counter-cyclical capital buffer is currently positive in 17 EU countries or EEA countries, while it's 0 in 10 European countries. And what we have seen so far over the past year, that 18 countries have taken macroprudential actions in the EU. So clearly macroprudential policy is active in Europe. But now looking at what could be done, and this is really the topic of this discussion, is how to improve the framework. And what I'm going to say here is really looking beyond of the near term, but looking in the medium term. So what we can do is, of course, to improve the current framework. And I think what really needs to happen, more than the experience that we saw, is that we have consistent, forward-looking and active policies. So for instance, I mentioned that the buffers were not built well for the COVID crisis, so there were not buffers to be released in all countries. So we should really draw some lessons from here. Also, what was one of the topic of Stefan Ingves' yesterday's speech about the complexity of some processes. So clearly what we want is to have macroprudential policy that is streamlined and can be usable to the authorities without the hesitation, how should I do this so that I get all the processes right. Also the important point that was mentioned by Markus is, so we have to look beyond the banking sector. So currently in the narrow sense, the macroprudential framework is available to the banks and to the borrowers, and particularly to the households. But we know that the EU financial system is changing, And we would need to be prepared also to manage the systemic risk outside of the banking system. And also, we need to be prepared to really counter and mitigate sources of systemic risk that are new. And here we will talk about in this panel also particularly climate risk, but cyber risk, for instance, and the technological change that Stefan Ingves mentioned yesterday are those that we would need to be ready to address with the instruments. So I'm in a lucky position because the ESRB actually made a lot of thinking about how the macroprudential policy framework should develop, and it issued in March 2022 a concept note that outlines really these three dimensions. So how to improve the current framework, how to enhance the regulatory parameter to beyond banking sector, and then how to address new sources of risk. So I would actually recommend everybody to go to the ESRB website and have a look of this concept note that contains a lot of useful information. Given the time, and I will focus on this second topic, on the broadening of the framework, and I will actually particularly look at the borrow-based measures. So I think my lesson from this conference, although as we heard there are some mixed results, but my own interpretation of the experience so far is that borrow-based measures are more effective of mitigating systemic risk, while the capital-based measures can be used to increase resilience. So it is very important, therefore, to have these instruments available for all macroprudential authorities in Europe and have a complete set of those instruments so that they can actually use those tools effectively to mitigate sources of systemic risk. So I actually don't have to explain now the borrow-based measures, how they function, because this we have been discussing a lot, but just to say that they are indeed complements to the capital-based measures. So what the ESRB concept note outlines is really a minimum set of common standards and tools that could be included into the EU legal framework, so that actually the EU legal framework would have those tools available that actually we conclude have been more effective than those of the capital-based measures. So to really complement and make this macroprudential framework more complete to address sources of systemic risk, we have to go step by step, and clearly there is more evidence and more experience of looking at residential real estate related risks with the borrow-based measures, and our proposal really is to start with those. Clearly further ideas could go to the commercial real estate, also talking about other types of borrowers like firms could be in the future, but what our proposal here was about residential real estate. And the motivation was really threefold: to be able to effectively mitigate sources of systemic risk, also to reduce inaction bias that has been discussed a lot here, and then also to facilitate further integration of the European lending markets to help to facilitate cross-border lending. So I will go through these three topics one by one. So one point which is very important is that this framework tries to be providing a minimum set of common standards and instruments, but it leaves a lot of freeway to the domestic specificities. So we have to start step by step moving to the right direction, not to try to have a situation that would actually lead any country to a worse of situation. So what we want to really, with this proposal, is to harmonize to some extent, but try to do it in a way that it would be not harmful for the national macroprudential frameworks that in some countries work really well, and there is a really good experience of using them. So that is the important point. So we want to use proportionality, etc., really as a guiding principle. A second very crucial point is that these macroprudential tools, the borrow-based measures, should be left for the national authorities. So that's absolutely clear. Nobody wants to move the responsibility to anywhere else. And what is important is that we should really try to have measures that comprehend all lenders, because as we know, the activity is moving also out of the banking system. The issue why we would need this is that we have very divergent national frameworks for borrower-based measures. As mentioned, in some countries, they are quite complete. You wouldn't even know what to add. But in other countries, they are not. And there are issues to implement those measures that are even available. So what we want to do is really to provide a framework that would have a backbone in the EU law so that it can be really mitigating these issues. And what we want to do here is to provide both collateral-based instruments, so the LTV ratio, for instance, and then those that are linked to the borrower's capacity to service the debt, so debt service to income, DTI, maturity limits, etc. The second issue is the inaction bias. We have been discussing that. So there can be procedural issues or there can be legislative issues that prevent timely application of the macroprudential policy, and particularly the borrow-based instruments, which, as Torsten Beck also mentioned, are one of the most political ones, because these are really touching the issue of who has the access to the lending markets, the housing policies, etc. So what we think would be useful is that there is this EU law, the framework that is providing it, and there is also some basic principle for governance that would then mitigate this inaction bias that is often the case, that has indeed been leading to the not so timely actions. And I want to emphasize that the borrow-based measures, and I forgot who said it yesterday, that their early application is the key. It's the least costly when you apply it in an early phase, and it ensures sound lending standards throughout the cycle, and therefore it's very helpful in that way to mitigate the sources of systemic risk. And one topic that would be useful is that there is, of course, more transparency. There is some need to, for instance, do annual assessments and publish those annual assessments. So there would be really sort of reasons and backbone for the macroprudential authorities to do this work without the political interference. The last point, the third point of this proposal is to actually promote the single market and cross-border lending. Clearly, we completely agree that not having the EU macroprudential instrument for borrow-based measures is not the main reason why we don't have cross-border lending in the real estate markets in Europe. There are tax issues, there are bankruptcy laws, many types of other factors that are much more important. However, if we would have a common set of framework, common set of minimum harmonized instruments and tools, it would really facilitate the borrowers to understand that, okay, I can actually take a loan from another country to my house, but it would also help the banks and other entities ultimately to compete for those customers, and we think it would be having a positive spillover to this. But this of course is something that is hard to quantify in advance. So let me turn, after talking more in detail on the borrow-based measures framework. One important topic is systemic liquidity risk. And to say the least, when I was Googling systemic liquidity and indicators for liquidity risk, it seems that this topic is every now and then, every 4 or 5 years, hot topic. This has been really researched over the time, but so far I haven't found any good systemic liquidity indicator available ultimately. So clearly it's an important factor, has been the mother in crisis of the vulnerability, but still there is a lot to do. Clearly, we have seen in the past crisis how, for instance, monetary policy has been stepping in and helping the liquidity situation. But what we want to now promote here is that there is a system-wide perspective to analyze the liquidity risk, and also to facilitate some way more harmonization. So, for instance, the high-quality liquid asset definition is not consistent across all the different sectors, the banking and non-banking sectors. So clearly, having more harmonized way of defining the liquid assets would be helpful. But also then to actually clarify that there are possibilities to go beyond in the banking sector, for instance, of the liquidity coverage ratio or the net stable funding ratio, with potential other tools would be helpful. And one topic that has been a long time in the ESRB's research agenda is how to make margin requirements less pro-cyclical. And this is, of course, one source which then is leading to liquidity squeezes in the market. So there are many perspectives that we can work on to help on this systemic liquidity risks. Last point where I will not be able to do the justice, but I know that my colleagues are here to Christina particularly will talk about it, is the macroprudential policy framework beyond the banking sector. So the key point here is to look activity-based regulation versus the entity-based regulation. So if you have an entity that provides mortgages to the households, but it's not called a bank, it should be actually regulated and being held for resilience exactly the same as for the banks, but of course taking into account its own risk perspective. So this is very important, that you don't allow regulatory arbitrage by not regulating all the entities that do similar activities. But actually looking really more on the medium run, and this is something that we are starting to work on, is really to consider whether it would make sense to have a macroprudential framework that would cover the whole EU financial system, rather than looking at the piece by piece, but really trying to think it from the horizontal and cross-sectoral perspective to really capture the systemic risk that really would encompass the whole EU financial system. One issue that I didn't mention, but it's clearly something also in our agenda in looking at the third point of the ESRB's concept note, was to look for the new sources of risks. And Paul here will talk about climate risks. That is one central new type of a risk that we should know how to counter for in the EU systemic and macroprudential framework. So this is one dimension. I mentioned also the cyber risk, for instance, and the AI-related issues that Stefan Ingves talked about yesterday. So we have to be really quite urgently looking into these topics, because these risks are there, and we have to be, as Torsten said, one step ahead, hopefully. So this is important. There are also ways how we could do, maybe with smaller steps, to improve the current banking sector-oriented macroprudential framework, making it less intense on the processes, and also helping to to actually let the authorities to be more active, more forward-looking, more consistent, and so forth. So these are important points that we can do more in the shorter run. And then there is this whole topic of looking at beyond of the current banking sector framework. In our proposal, we have clearly one way, which is the borrow-based measures that would help to complement the current capital-based framework, but then also looking at the beyond banking sector, looking at the activity-based tools, and then maybe considering even ultimately the whole financial system. So with these remarks, I thank you.
Thank you, Thomas, for this broad overview, I think, which provides an excellent basis to dig into some of the issues you've talked about a bit deeper. And I would invite Paul to do this on climate risk.
Okay, so thanks very much. And thanks to the organizers, I think, for an excellent thought-provoking event. And also to Professor Beck, I think, for throwing out the gauntlet in his remarks in the last session on climate. And I would tend, you had 2 points, I think, you made, which are quite good ones. First is climate just another macro risk. And here I would say, yes, with an asterisk. There are some specific features. But by and large, I think what you'll see is that the macro-proof framework, our impression is, can handle the types of risks, the financial risks which stem from climate change. So credit risk, market risk, operational risk, the traditional types of risk. The other point I think you threw out in the gauntlet was, should we also be concerned that in imposing requirements to manage climate risk, we might actually do some harm? And there I think that is a more open question about Tinbergen type questions. What is our mandate? What is our policy attribution? And I think our mandate is indeed to handle financial risks associated with climate change, not green objectives themselves. And hence, this also gets in the direction, I think, what you said at the beginning, Marcus, about mission creep. So we do need to be concerned about this in a climate sphere. And I think there certainly is a lot of pressure in that regard. So let me press forward with what I would like to do is get to that asterisk I mentioned at the beginning. So climate may be another macro risk, but it does have some specific features. And I want to go through some of the evidence we have collected on climate change, which gives us the impression there are some differences. Probably differences that can be handled by the macroprudential framework, but with a little bit of potentially a twist. And then I would go to the macroprudential questions, which I think are live ones. So I'm very keen on this conference having explored these, because I think a lot of them are very relevant for what concerns climate change and macropru. So let's start with the evidence. And I think the first question is, what are the salient features of climate shocks? What should we expect? And here I think what we've basically lent or borrowed, I'd say, from the climate community, so the scientific community, is that it is not only likely but an inevitable shock. We will face climate shocks one way or another. Transition risk associated with starting to increase the transition from what you see on the left-hand side chart here, which is pledges and targets of governments as they currently stand, do not entail meaningful carbon reductions. What's needed is to move forward to these sorts of targets or objectives which have yet to be quantified, which would move us onto a trajectory of reduction in emissions. And I think that reduction in emissions is going to be very stark, should it occur. To bring us to a 1.5 degree world, we're talking the types of emissions we saw during COVID in March to June 2020, where you had basically cities completely shut down. Those types of emissions, so around 7% for that year, have to be sustained over many, many years. So if that is to be actually pursued, we're going to see a major transition risk shock. And if it's not pursued, we're going to see the proliferation of physical risks because we're near tipping points. So the baseline is now 1.1 degrees warming around the world, which terrestrially, because most of the world, about 70% is water, would mean actually about double that, so over 2.2 degrees. And as you move northward, of course, or away from the equator, that gets even more extreme. So in this world, I think what we have to be worried about is tipping points. And of course, the world of systemic risk is well equipped to looking at tipping points. And the tipping points in this sphere will be really about elements of nonlinear dynamics also in the climate sphere. Now, I think moving that to the right-hand side chart is just to say there will be a necessary financial adjustment, and financial markets have not in earnest been pricing climate risk, at least the types I've mentioned on the left-hand side chart, sharp adjustments or major tipping points. So should that occur in earnest, I think what we're looking at is that you would need to decarbonize portfolios rather rapidly and starting preferably 2 years ago. So it's going to be a world of, if you were to decarbonize, your actual portfolios, you'd be looking at around 10% per annum reduction. But if you start to delay, it causes more and more potential sharp adjustments. So the scope for financial shocks is large. And I think what we've been trying to measure out with the data, we have proprietary data on the prudential side, is to better understand what are the exposures to these risks. And let me start on the side of physical risk. And so we've taken around 1.5 million firms and we've mapped them in terms of their exposure to hazards, 6 hazards that you see, I think listed here, at least we have some of them in the colors. So floods, as you can see here, questions about sea level rise, wildfires, and the like. And what you see is they're rather regionally distributed, and each dot here is a firm. And that regional distribution is important to note, that there are risk concentrations, and I think to focus on aggregates here would be a mistake. You need to get very granular. The right-hand side chart, I think, was a rather big surprise in engaging this work, is that what we saw is that we would have thought in a mature market like Europe, you would see a lot of insurance already, and to our surprise, you don't. So only around 25% of climate-related hazards at the national level on average in Europe are actually insured today. And that can even run down to around 5% in some countries. And if you can imagine going forward, as you see more veracity of physical risks or hazards occurring, you're not likely to see that insurers want to cut premia or expand coverage. They probably do quite the opposite. So I think in this sphere we have to think about this, and I'll come around to the macro-pru space. What would we think about potential considerations which may follow from this observation? Now let's shift from physical risk to transition risk, and this is ostensibly just about carbon reductions. In carbon reductions, I think what's important again is to note granularity matters. There's a lot of heterogeneity, and the left-hand side chart shows us this. If you look across sectors, now here we've listed the 6 sectors which tend to be in the economic sphere, climate policy relevant sectors as they're known, seem to have on average higher emissions than other economic sectors. But I think what's important to note is within these sectors, you see a huge variation. This is now box plots are telling us about the variation in carbon emissions intensity over revenues of these firms, and that it tends to be actually really emissions efficient firms and really emissions heavy firms within the same sectors. So we'll need to think about differentiating this should you come to about risk management. Credit rating agencies are rarely downgrading entire economic sectors. They're downgrading firms relative to their peers. So this would be quite relevant as well. Now, on the right-hand side, it just tells us that banks are going to be central to managing high emissions. Banks tend to be, and this is, we've stratified now the emissions universe in the firms towards high, medium, and low emissions. And what you see with the red part of this bar is that bank loans tend to be predominantly towards high-emitting firms, and that has not been coming down in earnest. So managing that, I think, will be a key challenge, particularly for banks. Also in the securities holdings universe, you see a bit less of an issue and more dynamics in terms of adjustment. Now, of course, all I've shown you so far is about exposures. And financial risk, as we're well aware, is the interaction with financial vulnerability. So just sizing up the exposures may not be enough to tell you about what could happen. And here I think what our work has been in the surveillance sphere has been to better understand where are those risks most important, both on the side of physical risk and transition risk. And looking, as you see in this thing here, this way we've actually organized it, is in the non-financial sector, the financial sector, and also systemic amplifiers. And for this type of group, it's this below-the-line list, I think, which should concern us. Where could you see nonlinearities, systemic elements coming out of climate change? And from that movement towards risk, of course, you can see some of the things listed here that we'll need to keep an eye on. Again, many of them are in the traditional financial sphere, so not necessarily new elements. And I think the last thing to note in evidence before I turn to the policies is that there is a very strong path dependence in what concerns climate adjustment. So I guess that you say there are often two certainties in life, death and taxes. I think the third certainty you might have in this climate sphere is that once you put emissions into the atmosphere, they're almost impossible to remove, at least with current technologies and even foreseeable technologies. So in this sphere, early adaptation does matter. And the longer and longer it's delayed, of course, it's going to create bigger and bigger problems, if you will, in the physical risk sphere and potentially also the transition risk sphere. And what we have here is these representative scenarios we tend to run through our models. I won't go through all of these models. Actually, Katarzyna is here, is I think, one of the eminent persons in having run a lot of these models and come up with, I think, the result which you see in the bottom bullet here, which is the idea that this path might be also bumpy. And it would have very strong distributional effects. And we talked about the political elements here in earlier panels. This will obviously be quite relevant when it comes to climate. Now, let me turn to the macro-pru, I think, which is the focus of this conference. And note, in some respects, we do have the new wine, in, if you will, in old bottles. The bottles of Macropru are still the right ones, in my view. But I think what we have to think about, of course, is what are the salient risks and how might those entail externalities, which can then generate, of course, the motivation for public policy involvement in the prudential sphere. So, of course, we have classic risk channels when it comes to systemic risks, spillovers, nonlinearities, interconnections. We've been seeing all of these potentially relevant for climate. But this middle box on the top of also tells us a little bit more, again, about the specificities I've been noting for climate. It's concentrated. You tend to have also amplification when it comes from the collective lending of the sector, not just individual bank-specific lending, but the sector as a whole into carbon emissions can also entail, obviously, worse climate outcomes, which reverberate on the economy back to the banks. And lastly, of course, this amplification between physical and transition risk. And I think the right-hand side box on the top is really this idea about path dependence. What do we do with this? And how do we also layer that in? I think with all of this in mind, what we've been seeing in terms of the Macropru space and what our motivation would be is threefold, as you see on the bottom. First, this idea of build resilience. We've heard a lot of this yesterday. A resilient system which is not just robust at a point in time, but able to adapt as we go forward, potentially hard to predict unknown unknowns which will develop as we are in a genuine structural break. A lot of what we are expecting with climate change is yet to come. It's not in the past data. Secondly, I think would be important in terms of scope. It's not just banks and pushing the risk outside of the banking sector into the rest of the non-financial intermediation sector, but thinking more holistically would be, I think, one of the key elements here. And lastly, this element of what focus. What should be the relative focus of macroprudential regulation? We shouldn't take on board what governments are not doing in terms of industrial policy, fiscal policy, structural policy. And at the same time, we need to be mindful of the fact that there'll be macroprudential, there actually already are in place macroprudential initiatives, numerous initiatives to tackle this. Now let's talk a bit more about specifics. First, in the world of a general framework we would tend to think about, it's not going to be a surprise to you. Thinking about lender vulnerabilities, borrower vulnerabilities, and this idea of non-bank financial intermediation. So lender in this sphere, I'm thinking predominantly about banks. And I think what's important to ask is climate an absolute risk for the system, or one which is more relative in terms of thinking about the concentrations I mentioned? You want to be targeted, focusing on these areas of concentration, or just having a broad brush approach, I need to make the system more resilient as such. And I'll come around to this in a minute. What I think is the other important consideration is generating a lot of controversy is capital. Do we need more capital specifically for climate or not? Or can we think about other measures which are not capital-based? The borrower-based vulnerabilities, honestly here I think we're still a little bit behind because much of the work we've done thus far is about firms. The data is best for firms. When it comes to households, we're still trying to get our hands on better granular data. Hence, the borrower-based measures, whilst a promising avenue, might be one where we also need to motivate better with measurement. And lastly, non-financial sort of intermediation and non-bank financial sector. And here I'll talk about some of these now in more detail. So when it comes to operationalizing this, I think what's important to think about is, again, this nexus and this blur, if you will, between micro and macro is quite important if we stick purely with the prudential space on banks. So much of this Venn diagram you see here as the measures in a common space. And we need to be mindful of the fact that this coordination, policy coordination, will be important with climate. I think what I would like to focus on, since this is the macroprudential group, is really what concerns the left-hand side bubble here in this Venn diagram, and talk about some of the elements which would be much more attuned to a macroprudential standpoint. And that's the elements of looking in the toolkit as we currently have it, legislated in Europe, to systemic capital-based measures, some elements of sectoral requirements which might not entail capital, some aspects of borrower-based measures, and also addressing this insurance protection gap. And let me speak about this in the next slides. So systemic risk buffer, obviously here, is a very nimble tool insofar as you can have a general requirement for the entire sector, or you can actually have sectoral applications. Now think sectors here not as economic sectors, but as groupings of firms, which might be ones we need to manage. So I think that's a key one we're looking at. In terms of the non-capital-based ones, could we set thresholds over which we start to be concerned? So really about managing concentration as such, less about loss. Now, I'm not going to go through this table. It gives us a much more sort of detailed overview. It's the actual reference to the report is there if you want to look into the measures as they currently stand in our capital requirements directive and regulation. But of course, I think it's useful to have a think about what what potential tools may be the right ones. And what you see in green are the ones we've identified as the ones we think are best. But rather, let me just speak briefly to the question about capital for climate, because I think it was raised also as one of the gauntlets thrown. So one thing I think from a paper from the Fed, some colleagues at the Fed, which I think was a really well-done paper, was asking fundamental questions. Will climate-related shocks increase the mean losses faced by financial institutions, or the volatility of those losses, or both? So this chart here on the left-hand side chart gives us the element of an increase in both the mean and volatility. But you can imagine climate might actually be yielding more volatility and not necessarily more mean level losses, and therefore hard to predict. In this environment, capital should be there to absorb unexpected loss. So you'd expect maybe earmarked for climate or not, but capital could be important in this respect. So I think we need to think carefully about what are the nature of the shocks and how might those augur for more capital, and where would that capital need to be held. One of the things which is being discussed, recalling the path dependence I'd mentioned earlier, is this idea of potentially having some sliding capital requirements. Not the ones we implement now, but we think about implementing these on a graduated basis depending on how risks evolve, since much of it is very uncertain and forward-looking. Now, lastly, on the side of non-bank financial intermediation, I just wanted to mention that's an area I think in focus as a systemic regulator should be. The perimeter of risk is certainly not banks, and certainly not within national borders either. So on the side of non-financial intermediation, I think what we've seen is obviously there are some aspects here of not just allocated market failures, but informational market failures. So the role of market discipline shouldn't be underestimated. Better information, standards, elements of tackling greenwashing would be important. And obviously the risk concentrations I've talked about for banks, you could think about for non-financial intermediation as well. I think the other important thing is how much might be resident in the insurance sector when it comes to physical risk. So physical risk may not be best managed by banks who could starve particular geographies of credit, but rather think about the insurance sector as being the key element here. In the insurance sector, I think you can think about this ladder we've listed here. There's a publication underlying that if you're interested in more detail, that there may be difficulties in private insurance markets from dealing with non-diversifiable risk, so systemic risk, and hence this idea that you need to think about moving up this ladder progressively towards public-private partnerships, national level, or elements even of risk pooling at the EU level to handle the insurability of climate shocks. So with all of this in mind, I know it's been a lot, but I wanted to just give you a little bit of a summary, a taste of some of the issues. I'm happy to come back to in the discussion. You see here, I think you'll hopefully recognize everything I've discussed, and pass it over then for the next speaker.
Thank you, Paul. And especially thank you, I think, for working out and elaborating very well on what the financial risk part of climate risk is, because that is, as you have mentioned, always, there is always the danger of mission creep when we talk about this issue, and I think this has been very well elaborated by you on where the gist of the systemic risk lies. Now, let me hand over to you, Christina, for the non-bank part of what may be ahead in terms of macroprudential policy framework.
I'm not really sure I will be able to tell you much about what is ahead in the macroprudential policy framework, because the question itself has haunted me, actually. What is macroprudential policies? How should we address that when we think about the non-bank financial sector, which has many more complexity than the banking sector? So I'm going to talk about my own views. These are not the views of the central bank. And I can tell it's an honor to talk with the ex-governor in the room, which put a lot of pressure also on me to try to do the best job. But so to begin with, let me say that you have heard many times that the non-bank, the other thing is, how do we define beyond banks, right? I've been thinking about macroprudential policies for non-banks. So there are two things I had to define. First, what are macroprudential policies? And then what is non-banks? And non-banks we usually think about like non-banks financial institutions. So basically the classic shadow banking, which we don't call shadow banking anymore, plus all of the other actors that have grown in importance over the years. And we know that especially in the United States, but in Europe as well, they have really kind of expanded and have become very important for the real economy. Basically, the total asset under management has doubled in only the last 10 years, even in Europe. So what I thought is that you probably have seen all of the IMF, ESRB, all of the big agencies' reports. So I wanted to give you a flavor of what happens in Sweden. Because this discussion is very actual in Sweden as well, because we have a very large non-bank financial sector, actually. So in this picture, on the yours will be the right side, you basically see the latest total assets in Sweden, in financial assets in Sweden, in the first quarter of 2023. And you can see the blue part is actually banks. So this is the amount of total assets, financial assets owned by banks. And on the other side, you see all of non-banks financial institutions in big categories, of course. Then you will have a big chunk that goes to pension funds and insurance companies, which tend to be more regulated. And then you have likely almost as big chunk that goes to investment funds and basically other financial institutions. In this case, it will be CCPs, but also those very famously or unfamously known family offices, of which has been a lot of discussion going on. Okay? Now, on the family office and the CCP, I know very little about, so I'm going to focus on the investment funds. All right? So I wanted to show you the other picture right here. On the other picture, on your left side, so basically what you see is the gross savings of the Swedish citizens in funds of different type. All right, so you will see the very not pink, lila. I actually don't remember the word in English. Violet side is actually the money market funds, on which we have had much discussion in the last, during the pandemic, in the last 2 or 3 years, and before, actually, never-ending discussion. Then there are bond funds, but what's really interesting, to me at least, is the orange part, which is equity, open-end equity mutual funds, okay? So you can see that they have been increasing before the great financial crisis, immediately after the great financial crisis, and they have expanded even more during the period of low interest rates, at times negative interest rates. And I actually wanted to show you a picture of how these funds have become relevant for the real economy. They finance a lot of the real economy. So that's a very important thing. They give the investors diversification powers, right? Not everyone, we have seen a shift from deposits to the stock market because they've been more accessible to investors. So there's been more accessibility, which they have provided. One interesting thing is that everything I'm showing here, these are not only funds that are registered in Sweden. The majority of these funds are registered in Luxembourg, which from the small open economy, which is never an island perspective, is problematic. Because we could work on macroprudential tools at the Swedish perimetry, but we will never see the full picture because most of the funds are actually registered somewhere else. The other interesting fact in this picture is that most of these funds belong to investment management companies together with banks. So you have the banking arm and then the investment management arm. So they are all in the same framework. And they have actually not direct interconnectedness because funds tend not to hold cover bonds of banks, so there should be these Chinese walls. But definitely they are a very important side of the banking business. And that's actually very lightly regulated, right? And then we go into this idea of regulatory arbitrage and doing things on the side. So this is just my introduction picture to say that even in Sweden, even in these few words, you can identify already how many of the issues I'm going to touch upon in this discussion in the next, oh, this is going down. I hope. Okay, 9 minutes, apparently. All right, so of course, as many have mentioned, thinking about beyond banks without mentioning fintech and decentralized finance will be very narrow-minded, right? Because fintech has grown a lot of importance. Actually, fintech, to me, was just financial innovation that has been growing into more and more financial innovation. What we used to do on the web, now we do on apps. But that has made the accessibility of finance even more fast. It's like, it's like a junk food. You are always there, and often you are always there looking at how your portfolio is doing. Can you invest in something better? What is going? What are the opportunities? And this is actually increasing also the social media effect that we have been actually thinking if we think about spillovers effects, right? Then, of course, it's not only non-banks or fintech, banks are smart. They've been acquiring a lot of fintech because they could not in-house produce fintech. They are not innovative enough. The Lehman Brothers case is like the epic case of not having anything digitalized, right? And I remember another dinner speech in which basically you had to look through the papers. Banks have not improved very much because when you collect data from banks, they don't know where the data is, and they need to figure it out. So they've grown not organically through their own innovation, but from buying innovation, which adds another layer of complexity to this. The interconnectedness here is very big and complex. That's the message I'm going to go for. And then, of course, there are non-banks fintechs, right? All of the new payment systems that are through completely different platforms. Insurance now you can actually do online through apps. You have several different apps. I've never paid with cash, not even outside of Sweden, because I use Revolut. So I don't really need to. I mean, sorry, this is not marketing, but just to say, you really don't need cash. Not even in countries that use different currencies, you need cash anymore, right? So this has to change the way we look about the non-bank financial industry. And then, of course, this is actually a topic I'm very controversial. Stable coins. What are stable coins? What are really stable coins? We don't know, but we know that because of people feeling that regulation is strangling their options, and they want to be free to invest in many other things in which the regulators is not involved, the market is actually picking up. And most of the time, and this is another point I want to raise, people don't understand the risks that they are taking because financial education is too low. And that's something else we should work on. Improve financial education, improve the understanding of risks that the people are taking. Because in this industry, in the classic industry, I don't know how to go back, but also in the new one, basically returns should be proportionate to the risks. But that's not always the case, right? But you only look at the returns, but you don't really understand. It was Professor Holmes was saying yesterday, if you are selling apples, then I should not find out that you are selling oranges. You should sell what you actually, I think you are selling. So improving transparency information in this market is key. But what is important is that this is a very small market, but still we need to keep an eye on the small market because the regulator, and I am a hybrid. I'm like an electric car. I do a bit of both. The regulator should be ahead of the curve rather than waiting for problems to materialize before we start regulating them. That would be too late, I guess, especially in this context, because this technology evolved very fast. And this brings me to some of my research from the past, and more focus on the animals in the zoo that we know best, which I feel more comfortable with, which will be investment funds. All right? Investment funds, we have known from years of research that they amplify market shocks, but in a temporary way. Markets usually tend to recover. So this is a paper that I've written myself with several co-authors. And it's a paper in which we look at the market reaction during the great financial crisis. This is an event study because of endogeneity. You should always look at event studies. So basically, what we are looking at in this case is the reaction of basically the stock price of stocks that were mostly held by investors with a long-term horizon, which means investors that don't trade very much. They don't trade on a quarterly basis. They don't trade every 2 quarters. They tend to hold the stocks in their portfolio for about 1 year. And that has shrunk a lot, actually, if you look at the data now. And here, instead, is the stock reaction of stocks mostly held by short-term investors, what we call usually open-end mutual funds. And the idea here will be immediately for the regulator, oh, it's because they had redemptions. They were pushed to sell because of redemption. Actually, no. These results are controlled for redemptions, for net outflows. They are controlled for firm characteristics. The short-term investors in this particular case, we argue that they were selling just for the fear that liquidity will dry up and they will have to make losses and then they will face the redemptions. So they wanted to prepare themselves. It's about preparing themselves. So you can put restrictions on, redemption gates, swing prices. Those are restrictions on the client, but it will not kind of adjust the behavior of the agents, which will always anticipate the next shock because they want to maximize the profit, because at the end of the day, they know that that's what investors look at. Okay? What is very important is that this shock is temporary. Then basically the return of both type of stocks have recovered, and eventually there was no difference. And what I want to say is that this holds true in many other crises. So here you have different crises, all crises. I should update this, and I guess now you will have a lot of redemption, which will play more of a role because of the dissemination of information. At this time, as I say, you didn't have your phone to look at it all the time, and this slowed things down. But we cannot slow technology. I mean, that's definitely a case. We will create other distortions. So in this case, we have the benefit that redemption occurred slowly, so that's probably why we don't find the effect of redemption. So if we will do this, redemption will play most likely a larger role. But there's also evidence that redemption funds, hedge funds who experience redemption also sold very, very heavily. Okay? So these are examples of liquidity dry up, and I hope I gave you an idea of how careful we should be with regulation, because what are you really regulating unless you know what the problem is and how the agents will react to both the regulation and market changes. Because these actors are driven by greed in a way. They want to maximize their return because they want to keep their investors. They compete very hard. And as of now, if you talk to funds, which I actually do a lot because of the climate risk I work on a lot, they have a problem with fees. Usually, when we think about active investors, active traders, they were disclosing information, right? They were getting information about stocks, and then they were getting fees in order to disclose this information. Now, most of the market is going toward very low fees investments, low fees mutual funds, which don't disclose any information, and they don't do any information collection. They just try to exploit basically appreciation and depreciation in the stock market. So this is also another layer of complexity. Now, this is actually a table from the ESRB, one of the reports of the ESRB in 2022. And I want you to focus on this part. On this part, you see the several risks, which are, I talked a bit about liquidity transformation, the issues of liquidity, right? Then we have the issue of leverage. We know that a lot of funds are leveraging up, but that is not a very common issue. I mean, there are some funds that do it more than others, but we also need to think about the fund base. Who are the clients of those funds? What kind of returns they are trying to generate? Because that's also a lot to do with this picture. Then interconnectedness. I hope I gave you a good example through this talk about how interconnected these actually markets and actors are, even with banking system. And then search for yield. Now yield are kind of stabilizing thanks to a more monetary policy, increasing interest rate. So there will be many investors. They are looking for safer returns. Now they have an alternative. If banks start actually transmitting to the deposits also the interest rate, then they will have a safer alternative, which will create more safety, and there will be already a shift from the non-bank financial institution that gather to the normal citizen to basically more banks deposit base, hopefully, depending on how things will look like in the future. One thing I'm really interested in is these data gaps, right? It's not true that we don't have data. We have a lot of data. We don't know how to use it. Often we don't have the resources to use it. And often the data is reported very badly because the way we collect data is not done by people that know how data are going to be used. And this is a real issue. And it's a real issue especially for a small central bank that does not have access to a centralized ECB database, for example, or to the experience and resources in other central banks. So I think this is another issue that we need to think about. So to conclude, because I'm actually the one going over time, Marcus, I'm sorry. One thing that when we think about potential, as I said, I will think about macroprudential policies like more of an holistic type of policies. All type of policies could be macroprudential policies, let's put it this way, with the objective of creating resilience. We want to create resilience, but we are still very unclear about the long-term effect of the macroprudential policies that we have had in place so far. So we should be more sure kind of what are the right ones, and maybe tailored policies will be more effective in this very diverse. And I'm also, yes, so one has to think about long-term effects. The other thing, and I am trained as a corporate finance person, access to capital is very important. Impact on wealth inequality are very important. These are all things that feed into the problems that we see in the non-bank financial institutions, which imply that all policies have to work together. The other thing, we have regulated banks very hard. or hard, according to them, terribly hard. But anyway, the thing is that we still see banks fail. And they fail because their business model is unsustainable. Those are fundamental runs. When the depositor of SVB ran from that place, they were right. They had a very bad business model, and they should run. So we cannot prevent all failures, and we need to live with short-term volatility. We need to kind of accept that it's healthy to have, some failure. And of course, we need to coordinate policy and harmonize them, because it's very important that we have one view about how to do things so that we avoid arbitrage, regulatory arbitrage, and also very important for the climate. Climate is very important. Country-level investment in climate transition is very important because it's another market where the funds are battling it out. And then, of course, we want to avoid moving things to more opaque institutions, which could be actually the next problem. So I will say better data, and think also about making more costly failure as an effective deterrent to begin with, and also more work on, because it looks like we know a lot about non-banks, but it's actually not true. There's a lot of research that can be done, especially from understanding how to regulate the risks and where the vulnerabilities are coming from. Sorry, I went over time, but I hope you don't mind. Thank you.
Thanks a lot. Thanks a lot, Christina. In one of your side remarks, you actually said that as a regulator, you may be interested to know what you regulate. Yeah. And I guess it's a lot easier to know who you regulate than what you regulate.
It's true.
Which is perhaps the reason why we still have entity rather than activity-based regulation in large parts of the world. But let us now turn to you, Gonzalo, for an industry perspective of macroprudential policy. The floor is yours.
Thank you very much, Marcos, and thanks to the organization for inviting me to contribute to the debate on macroprudential policy, looking back and looking ahead. In a beautiful city, I must say, and with the occasion of the 30th anniversary of the Central Bank of Slovakia, and in the unique atmosphere that you always create in SUERF, so thank you also to the Bank of Finland and to Ernest for that. You mentioned, Marcos, that you announced that I would be critical, speaking from the view of the banks. And I must say, when I was preparing what I'm going to say now, looking back, I didn't find many reasons to be critical, but more reasons to be grateful. However, I will also talk about challenges that we all have looking forward. My first point is about the sequence of events when a crisis, a big crisis, bursts. Let me put those two examples. The first thing is about monetary policy. In the conversations yesterday, it was said that it is somewhat interlinked with supervisory policy. I think it is not exactly interlinked. It should take priority. If we look back to 2008, the US came out with that travel asset relief program, $2 trillion, and the market was completely calmed down. The same happened in the pandemic when the European Central Bank came up with the TLTRO3 in June 2020, and also with the weekly auctions to bridge the gap from March until then. So that's an important part that can take us to the second stage, that is when the macroprudential measures are put at work and the supervisory flexibility to deal with the situation. In the presentation yesterday by Cornelia, it was clear that we also did something well some years ago when the Pillar 2 was split into P2R and P2G. And she showed that about 140 billion euro were used to reduce the buffers, of which the bulk was P2G. And that is for a reason, because it's much harder for a bank to use P2R because it shortens the distance to the MDA trigger, in other words, to bad things happening. So that brings us to a reflection about the role of MDA in the management of crisis for two reasons, because it reduces the distance. It also raises questions by investors, and it can also reduce the credit supply. in one of those studies in the working series papers of the ECB, in the very good compilation that Professor Beck referred before by Pedro Duarte Neves, we found one of those studies in the pandemic showed how the banks that were closer to the MDA trigger were less able to maintain the credit supply than banks that were farther away from that threshold. So it's a significant metric, and I would say looking forward even more, because so far we have only experienced the MDA on dividends. But from now on, the MDA also hits subordinated debt, and in the case of Europe, all banks, because they have to issue MRL. And one thing is to reduce the dividend, a situation that somewhat can be, it's not a pleasant situation, but it can be managed. Other thing is to tell the market that a bank wouldn't pay a coupon. So that's a point for careful reflection, the question of the MDA and how to deal with that. My second point is about what we have to do next, what is to make buffers more flexible. I think there is a common agreement about that. However, when it comes to take decision, it's more difficult. We have the buffer set by the international standards. Capital conservation is fixed, countercyclical is variable. Moving the Basel standard, that could be an option, but that would take time, and it would have to be done at international level. When we come down to Europe, we have a series of buffers at national level, systemic risk buffer, the OC buffer, that it is international. However, it is applied, I think, massively in Europe with 170 banks, while, to my knowledge, it hasn't been used yet in jurisdictions like the US or China. So we might have an opportunity to make room for the countercyclical buffer by reducing the systemic risk buffer at national level that is only European, and potentially also merging it with the OC buffer. Finally, the management buffer of banks could seem to be an appealing chunk of buffers to be reduced. However, for the reasons I mentioned before, we should also be careful about that, because that would shorten the distance to the MDA. A third point I would like to raise after all the insight and the presentations yesterday and today is about the alternative measures. We've talked about borrower-based measures, which is it's quite interesting as an alternative to lender-based measures like buffers. And I would say, conceptually, borrower-based measures based on income are conceptually the most useful in terms of predictiveness of risk. However, from an operational point of view, they are very difficult to implement. And I mean the income-based measures, because within the borrower-based measures, I would like to distinguish there between income and collateral. That's something that I was lucky to work for 25 years in the risk division of a bank that took risk management very seriously. And I perfectly remember first lesson is we only have to look at the borrower capacity to repay the debt, generating its own resources, be it a household or a corporate. And then there is collateral. That is a second question, right? So if we manage to come up with a ratio based in income that can be operationalized, that could be very powerful. However, we had already that discussion in the revision of the standardized approach, and I think that income is a very difficult variable to grasp because it would have to be updated continuously. People borrow for a mortgage, typically with two co-holders of the property and the mortgage, and then things happen. There are splits, divorces, loss of jobs, different situations. So you would need to follow that on a monthly basis if you want to have accurate information. Then collateral-based measures are less interesting conceptually, but more pragmatic. And we can come back to the example of the real estate crisis in Spain, where the asset quality review revealed that the loan-to-value was a very good proxy of risk. meaning that portfolios below 60% loan-to-value had very, very low losses, almost next to nothing, even in a severe real estate crisis like that one. But that brings us to the social aspect as well, that I think Professor Beck already commented in his presentation, because from the point of view of a bank, the ideal situation in a mortgage is to have a 50% loan-to-value in the bank and a 50% loan-to-value in the family or the grandparents of the young borrower. That is ideal, and we would sign that. But unfortunately, in the society, there is also need to offer mortgages to loan-to-value up to 80% or even 90%, so we need to deal with that situation. And finally, another note about lender-based measures, meaning buffers. The usefulness of the buffers is to buy time. Time for the bank and time for the supervisor. However, I would argue that going forward, that time will be shorter and shorter and therefore more expensive. Let me put an example. Back in the late 90s, beginning of the century, there was that idea that was put in place in Spain with the dynamic provisioning. It wasn't named a macroprudential measure because, as well, you know, there is this 20 years of macroprudential policy history, and that was even before the term was coined of macro. But it was some sort of macro measure because banks had to set aside money and reserves in the form of provisions during the times of economic growth, and then 8 years later it was used, and the result was that even the weakest banks in Spain had more time to deal with the situation than their neighbors in Europe. A different question is if those 2 years of time were used wisely by the government in that occasion, but that's a different question. Of course, the buffers buy time. However, that time could be shorter and shorter, and we need to reflect about it. Another upbeat comment that I have is about the soft measures. I could only encourage supervisors to cooperate and to cooperate more in the crisis management groups, establishing contingency plans and protocols so there can be a swift reaction when things happen. And a very good example of extreme cooperation was the constitution of the single supervisor in Europe. That is probably the best measure to contain systemic risk that we have ever taken. So we are grateful for that. And I can tell you how things happen. When there was a big crisis in a neighboring country 4 months ago, at the Federation, I received a lot of calls from journalists. Would the euro area system be collapsed and contagion risk and so on? It only lasted 3 days, the time it took for the single supervisor to give a message that things were under control in the euro area. So that's important. Another point, the last point I would like to comment is about other risk. There has been a lot of insight. It's been fantastic yesterday and today. Cyber risk, I would only say we have to be humble. We are not used to dealing with cyber attacks. That's a different sort of discipline. We are risk managers in the banks and in the supervisors and central banks, but this is a different sort of risk. So my only advice is to sit with those who know more about that. IT companies, Europol, and other institutions out of the financial sector that can collaborate to prepare such a situation in the best manner. Second, climate change risk. Physical risk is, fortunately, only local or regional. Because if it were global, then a banking crisis would be a second-order problem. So if it is local, we can deal with it via diversification. Let's not forget that well-diversified banks are always more able to deal with local geographical risk concentration. Climate change transition risk, that shouldn't be systemic. If we do things right, it shouldn't be systemic. If we don't do things right, it might become systemic. So what we are claiming there is that authorities, well, the European Commission and other authorities, set out transition paths by economic sector and activity so that banks can benchmark every corporate exposure against those transition paths to 2030 and the ambitious goals that have been set. Only in that manner we will be able to allocate capital commensurate to the risk involved instead of putting buffers with no clear understanding of the risk they are covering. And finally, liquidity risk, of course, is important, and we always see that the media, let me say the media plays a very important role, and there is also media risk in some situations, as we have seen this year. It gives much importance to the liquidity risk. However, when we look at the crisis that we have experienced in the last years, many times it wasn't a problem of liquidity until the last day, of course, but we need to be sharper in the analysis and look at the real cause of the problem and not the consequence. We all have that image in the 2008 case when people were queuing in front of a branch of Northern Rock, but it wasn't liquidity, it was a problem of a very aggressive business model that was not under control. Then Popular was a case of credit quality deterioration that was coming until the last day. The bank couldn't open because there could be a bank run, or this Silicon Valley, what is a complex case of crisis, was more about lack of risk management, especially in the area of interest rate risk and some supervisory laxity. So about liquidity risk, maybe from a macroprudential perspective, we need to look at more the monetary policy, the other forms of money that could eventually in the future replace the bank accounts and the stable deposits that are the bedrock of the lending in the banking system. I would look more on that part of the liquidity risk in the future. And I would stop here and give the word back to you, Marcus.
Thanks a lot, Gonzalo, for your perspective. What I can confirm, having introduced borrower-based measures a little bit more than a year ago in Austria, is that they are indeed a very sensitive issue. When we first introduced the systemic risk buffer in 2015, we got used to criticism, but that didn't help us a lot with borrower-based measures because the storm that broke loose after that was really of a different magnitude. So I think that is truly something also from a European perspective we will be interested to see how things move forward. Let me now turn to questions from the audience. There are 2 questions over there. I think we collect a couple of them. 3, I would just ask you to direct your questions directly to one of the speakers if possible. That would facilitate things.
That's difficult, but I'm going to mention some of the speakers. So thank you very much for all your thoughts. These are issues maybe for your potential elaboration. Is what I take from what I heard in terms of what would be the incoming changes in paradigm for macroprudential policy. But this is my digestion of the challenges and issues that you have been mentioning. For instance, I think connected to Thomas and Christina's views on difficulties and challenges coming from the less known non-bank financial intermediation, also Gonzalo, and issues of liquidity risk. I think Thomas referred to those 2 separately, but actually also Christina in some of the remarks were making clear that in the non-bank financial sector, one of the major sources of spillovers to the rest of the system comes from liquidity risk, or comes from when markets get nervous, the margin calls go up and so on and so forth. So in terms of changes in paradigm, I think, and we always say, but then it's very hard to advance in practice, that we should go or advance it towards a truly integrated, cross-sectoral surveillance framework. So Thomas said, I still don't know a good liquidity indicator. Probably there will be no one. I know there is some work done at the ESRB in terms of developing a set of liquidity indicators. I think this is very promising. But maybe coming to my own field, I feel that the way to make sense of the indicators will be through a wider framework that really captures the connections between sectors. Because the indicator will have importance in the context of evidence that when that indicator goes up or down, you are transmitting some shock, say stock market shock, from the non-banks to the banks in this or that measure. So maybe what I envisage, and I think we will all dream for it, is a system-wide stress testing framework to start with, and possibly beyond. Well, just in terms of integrating features, that will also allow to see, say, climate risk from a wide system perspective. The second point is, in terms of change of paradigm, is that I think maybe by legal definitions at the moment, we like to restrict macroprudential policy action to preemptive or preventive ex-ante measures. But I was struck by Gonzalo's emphasis mainly on crisis management features. I think you were like saying that you like very much what we did by its capacity to deal when the crisis comes. So I think it's a little bit artificial that we keep crisis management separated from the design, ex-ante design of macroprudential frameworks. This reminds me of when in a stress test, we adopt the very artificial assumption of a static balance sheet and no policy response. It's so artificial. So I think we should reconsider resilience with the best possible crisis management and make sure that we have the best possible crisis management in place. Well, these are the thoughts I throw to the panel. Thank you.
Thank you. I think there's been a question right beside you.
Thank you very much. I'm from financial institution here in Slovakia, Tatra Banka. My name is Lubomira Gertler. I'm responsible for the strategic risk management in the bank. And first of all, I wanted to thank the organizers for having such a very fruitful conference in these 2 days. And first of all, I want to mention that the central banks, they possess the expertise and the authority, while the commercial banks, they operate on the front line, and therefore they have the deep understanding of the risks and the dynamics within the market. In terms of this, I would like to refer to the poll. You had the climate risk presentation to you. And in terms of the climate risk, maybe I would like to make a note from the sector that we very much see this new topic emerging in the last, I would say, 2 years, where we see it as a kind of a culture change also in terms of the sector, like corporate sector, more or less, where we see that it is very important to find the mindset for the companies in order to be able to think of the zero carbon emissions and think about their activities, business strategies in terms of the topic on the ESG or climate risk as such. This is maybe note from my side. What I very much liked that you mentioned that the climate risk is transposed into financial risk on the one side, and then into non-financial risk. We see more or less, and we are starting from the position of climate risk being very part of the credit risk and the operational risk. And maybe here, just to mention in terms of the macroprudential policy in connection with the microprudential policy, because transposing the ESG or the climate-related risks into financial risks, these are more or less regulated by the microprudential policies in terms of the Pillar 2 requirement. And on the other hand, where do you see the borderline between the two policies? You mentioned the graph or a draft of the tools or the measures that are implemented in microprudential policy and macroprudential policy. But we see it's a very interesting discussion on the point that climate risk being part of credit risk, market risk, operational risk, and these financial risks, which are regulated by the microprudential policy, kind of in terms of Pillar 2 requirement. Where is the borderline then between the macroprudential or where the macroprudential policy starts to be effective and the measures implemented in terms of climate risk specifically? Thank you for your answer.
Thank you. There has been another question of the gentleman over there.
Thank you. Marek Ličák, National Bank of Slovakia. I have a question to Thomas. Thomas, we discussed during coffee break borrow-based measure, but I still have some questions. You mentioned possibility to implement it in EU legislation, borrow-based measures. You mentioned it should be rather flexible, just general, let's say, standards for this to allow flexibility on the national level. And then you mentioned that it's still very important to, or just to make sure that it should remain in the national hands. And I think even yesterday there was a discussion, a mutual agreement, it should remain in the national hands because it's very sensitive. You need to really know all these local specificities. It has an impact on the financial position of a household, real estate market. And if there are problems, some issues, still at the end of the day, it's in the hands of national authorities. So it should remain in the national hands. But then you had a slide where you also proposed some changes in the governance of borrow-based measures, and you mentioned that there should be an unnamed EU institution and should be able to assess risk in this country and to avoid inaction bias. So in other words, maybe to push this country into borrow-based measure. It was not mentioned like this, but that's my understanding. So the question is whether you don't see contradiction in this. On the one hand, to have it in the national hands, but then you have some minimum standards or a system that should come from EU institution and to push country into borrow-based measure, despite the fact that it's very sensitive and all these arguments I mentioned before. And second question is about ability of this EU institution to assess this risk. We have an ECB, and ECB has a very good expertise and knowledge in assessing cyclical risk, and also has a top-up power in CCYB, and I think they are doing very well. But borrow-based measure is a very different story. It's not like CCYB, because in CCYB you need maybe a set of indicators, slightly different approaches. But borrow-based measure, it's a very different story. You need not just data for this country, but you need even something more, knowledge, some expertise, knowing local specificities, and that's something that is in the knowledge of local authorities. So question is whether sooner or later this EU institution would be really able to provide good and proper assessment. Thanks.
Thanks a lot, Marek. As we are already eating into Martin's final remarks, I will have to ask you to be very succinct in your answers. And I would start perhaps off in the order with the questions have been raised, with the first question to Christina on the liquidity risk part of it.
Yeah, exactly as you're saying. And what I was showing, the mechanism there is liquidity dry up. So basically, liquidity is a very important component because especially short-term investors, they know they will always find a buyer But if they fear that they will not find a buyer, then they will start coordinating in trying to get out of the market. Like it's a liquidity black hole, a Morris and Sheen classical paper. But the thing is that the important part is also to think about the crisis management. That is a crisis. If you look at the picture, then we have a crisis that we should solve. If you look up to when the returns are going down, but the crisis solves itself because then funds went back into the market and provided liquidity, and many actually longer term horizon funds made a lot of money on betting on the reversal. Is the timing, which is so you need to endure the drop in order to basically wait for the market to start. Whether you should intervene or not, you can intervene in other, maybe calming the market with communications or other things were done at that time. So the market was calmed, but without their direct intervention to the institutional investors, onto the institutional investor side. But I also believe that crisis management is actually very important. As a very important tool we should think more carefully about also for non-bank financials.
Thank you. Gonzalo, anything to add? Because I think the crisis management was coming out of your part.
Yeah, no, I perfectly take the point of Javier, and well, I deliberately spoke about crisis management just to complement what other colleagues were saying, but let me say there are things that can be done. One of them that comes to my mind is work that we have done in the European Banking Federation in the last 3 years. We know that conceptually the recovery and resolution framework is robust. However, when it comes to the day of a crisis, there are certain problems. One of them, we identified, for instance, that a significant part of the subordinated debt of many European banks is issued in the US. So the question is raised, would this be converted rapidly into capital the day that things happen? So we engage in a study with a law firm, and also we offer it to the Single Resolution Board. These kind of things, are hidden behind the big macroprudential decisions, but help a lot to reassure that the framework would work as intended when it comes to operationalize it. But again, I think there has to be a feedback loop from the crisis management to fine-tune and perfect the macroprudential policy. That's something that we don't have to stop doing.
Thank you. Then we had a question, or two questions, I think, on climate risk. One of them, the borderline case of macro versus microprudential interventions. Paul, please.
Yeah, very good questions. And look, I'm happy to hear the coordinated exercises which are going on with the banking sector, I think, is bearing fruit. So in this respect, look, I think this is one of those elements where risk management, I think, really for us to start with the markets and the financial institutions. And that if you get that right, you don't necessarily need to consider macroprudential interventions, and which we heard yesterday sometimes have distortions. So I think it's an important element. I think in this respect, one role we are seeing ourselves as having is to collectively disseminate information, liaise with the scientific community on climate, which is a bit unfamiliar for all of us, obviate the need for individual institutions to do this on an individual basis, and thereby have a collective information set upon which we can all act. And I think coordinated exercises are a key part of this. Stress testing, both the bottom-up, what banks are seeing, and the top-down. How can we also integrate this? And I guess your next question, I think, about the macroprudential overlay. When do we see the scope to move from micro to macro? I think the question is really about two things. So I think one is about spillovers, amplification, which may go beyond an individual institution. It's sometimes hard to pick up in a bottom-up exercise. Because individual institutions rightly are looking at themselves and their counterparties. But I think that element of spillover is contagion, but also the aspect of feedbacks, either through the economy or through the climate-related issues, I think may be better picked up by coordinated exercises. And to pick up on Javier's point, I think system-wide stress testing is essential because we need to think also beyond banks, particularly for climate. So I think very good questions. I think these are open questions as we all face. And look, I think we're facing these together, and it's great that we move together in this respect.
Thanks, Paul. And finally, Thomas, a very easy one. Why and how to integrate borrower-based measures?
Oh, thanks a lot, Marek. And I was actually almost 100% sure that you will come in. So perhaps there was a bit of a misunderstanding. So the bottom line of our proposal is really that the borrower-based measures, even when they are in the EU framework, would absolutely remain at the national authorities. So there is a very clear point on that, that this is not any transfer of authority in this respect. And on the governance, the point was that, as we know, there has been issues with, in some countries, not in Slovakia, but in other countries, where either the process or the legislation that is required then to take the actions is very timely and potentially has missed even the cycle. So what we are proposing is a process that requires the national authorities to make the assessment of the risks and publish it. So to make really, let's say, a thought process, should we have borrow-based measures or not? And that's what we mean, that would then help also domestically the debate, because this is made public, the assessment, and therefore it should be helpful for the authorities then to take action. So this is really, so what we are foreseeing, for instance, dedication of this issue in the financial stability reviews, for instance, to help. So let's make that clear. Whether all this is possible in the current legal framework is a second point, and I don't want to get into that, but this is the proposal how we would like to proceed. And if I may, I actually completely echo and share the views of Javier Suarez on the need to look holistically. This was actually my first point in that slide of global liquidity, and also just to say that the ESRB is working on the how to make system-wide liquidity stress testing framework. So that's something to look forward. Thank you.
Thanks a lot to the panelists for very insightful presentations. Thanks a lot to you for very interesting contributions and questions. I think a lot of the things that we discussed will actually end up in the discussion to the macroprudential review, which, having been proposed, hopefully this debate will arrive soon. And I would hand over to Martin for the final concluding remarks. Thank you.
Why not, right?
Okay.
So, thank you very much. Well, I have 3 good reasons to be short and brief in my remarks. So the first one is that Thorsten has done a terrific job this morning in summarizing a lot of the frontier, of the challenges, of the research that can be done going forward. I couldn't possibly do that half as good, so that saves a lot of time. The second reason is that we will summarize a lot of the key findings from this event in a SWERF policy brief, so that will be done in the next couple of months. And third, the longer I speak, the later you eat. And I don't want that, so I don't want to, create any bad feelings at the end of this event. But having said that, let me just give you a few almost random observations that I take away from these 1.5 days. A few general points that came up in various of the panels and the keynote speeches. So the first one is about the definition of macropru, and I found this very interesting because the word holistic, I think, was used quite a lot and really in a very broad sense. So I think it's commonly known that there should be close cooperation between macro and micro supervision and monetary policy as well. But when it comes to things like fiscal policy, other policies, where housing was mentioned, and crisis management, I think this is a little bit less on the radar screen, and I think this is a very important point to think about this. What it requires is something that was also mentioned, that we don't work in silos when we do our analysis and policy recommendations. And I think this is difficult. Let's put it like this. And I think it's difficult both in institutions but also in academia. I think academics also tend to specialize in their specific areas, and there's not so many who look beyond the boundaries. So this is a challenge, but it's a challenge that needs to be, of course, overcome. Another point that came up occasionally, and I think that's also quite important, is to be aware of the trade-offs between financial stability and macro stability and macro growth. We can, of course, regulate the financial sector in a lot of detail. And I think, Thorsten, you had the word repression this morning in your presentation, and you canceled it out. But of course, this is in a way also something that needs to be kept in mind. And I think going forward, this is very, very important, because we have the climate change, the climate challenge that will require banks to provide a lot of financing. And what is happening in terms of regulation, micro and macro, is very, very important in this field. And speaking here in Central Europe, there's also the issue that financial deepening is not really as advanced as it probably should be, right? It's been pretty stable for the last 10 years, and I think more should be done there. And there is a trade-off with prudential supervision. Third general point, data. This came up over and over again, and I think it's absolutely critical, both at the policy side. You have to have very granular, you need to have very timely data to set up policies, but also for the analysis. And I think we've gotten better at this. A lot of progress has been made, but not nearly enough, I would say, especially when it comes to microdata, data on non-banks, or also data related, for example, to new challenges like climate. Now, just looking at some of the main findings from the individual session. So at the beginning, and this was a fascinating discussion, I think, where we summarized the academic work that has been done. And I think, for me, the general baseline here is that we learned a lot, but still a lot more needs to be done. The models have advanced a lot. They've become much more useful for policy purposes, but in particular for capital-based measures. I think when it comes to other tools like borrower-based measures, there is also some useful models out there, but a lot more needs to be done. I found it quite interesting also that it was argued that country-specific studies are methodologically probably more interesting, or not more interesting, but more promising, let's say, than cross-country work. That's something I think that needs to be addressed, because we shouldn't use this cross-country dimension. Of course, we shouldn't lose this entirely, and maybe things like the IBRF are indeed useful here to do. Then on the second session for the country-specific policies, this I found very, very interesting, because there was a lot of common ground. There was really a lot of common ground in that panel, and a few findings that basically all the panelists said. The first one is the importance of timeliness of the measures. I think everybody agrees on this. Of course, how you ensure this is a different matter, right? So the overcoming this inaction bias is very difficult. We all know this, but we know it's something that should be done. Also, governance. How should the macroprudential function be arranged? And I think there was a general agreement that doing this in a simpler form and having it in the central bank is probably the way to go forward, the more promising way. There were also a couple of very important questions raised in this panel. First one, we know a lot about the build-up phase. We know much less about the release phase. I think this is something that still needs to be addressed. And what I found also very interesting is the observation that we have currently a situation where policy tries to solve all problems. Right? We've seen this in COVID. We've seen it now in the energy crisis following up on the Russian war against Ukraine. And that matters. That matters a lot for incentive structures of economic agents. And I think this is something that needs to be kept in mind. Then, coming over to the third session already, I found it very interesting that there was a lot of harmony in the room between national competent authorities and European authorities, the ECB and the ESRB, and a national panelist saying, yeah, it's very useful to have the ESRB And that's good. I mean, having worked for ECB and now working for the NBS, of course, I'm very happy about this. And I think it's actually true. I think this is the way how things should be seen. The third panel, I think, was also interesting because it broadened the horizon a lot. There was the reference to Macropru, how it fits into general macro financial stability frameworks, which I think was very well taken. The external dimension of macroprudential policy is probably more for emerging market economies, but still it's something that should be kept in mind. And we had, of course, this very impressive and important reminder about liquidity and how liquidity is actually generated and managed by the markets. And then this morning, well, again, a great panel with lots of new ideas. I mean, this was the way forward, really, the forward dimension that we wanted to tackle, and I think we managed very well. So what have we heard? Well, a lot of new sources of risks. Climate, cyber risks, artificial intelligence, what does it mean for us? And that, of course, all of that opens a lot of new and exciting research opportunities and also research needs, I would say. On climate, just to say, well, I think the point that there is a need to build resilience in the banking sector, this is, I think, quite well understood. This is clear. The much more difficult question, which we didn't really get into in great detail, but it was touched upon, is the mandate. So how far should we go, actually, as macro supervisors? And I would not be surprised if this mandate will be tested quite soon, if other parts of government realize that maybe they cannot deliver or do not want to deliver, and the responsibility is shifted. We may have some interesting questions here to answer. On the non-banks, of course, yes, we know it's getting more and more important. Definitely, there is a gradual shift in activities, and I think the activity rather than entity-based analysis, that should be a key principle here. And there is a lot more need for data, even more than in the banking side, because we know data is less plentiful there. So I think, as I said, this is definitely not exhaustive. This is a little bit random, but there were just some observations that I had during these 1.5 days. So finally, before closing, let me thank the people who made this possible. So first of all, my colleagues in the organization committee, Ernest, Isa, Susanna, you're here, Jan, and I would also actually include Dragana here because she did an enormous amount of work. So thank you very much for that. And on the Národná banka Slovenska side, a lot of departments were involved. The protocol department did a terrific job to keep everything on track. IT, what would we do without them? Of course, it wouldn't work, especially for a hybrid event. Communication was very, very helpful. And last but certainly not least, colleagues in the research department who also did a lot of work to make this happen here. And lastly, I would like to thank all the presenters and all the moderators, and of course, the entire audience, everybody who is here, everybody who was online. Thank you very much indeed. I think there is lots of room to have more conferences on macroprudential policy, so I wouldn't exclude that we repeat this at some stage. But for today, the conference is closed. Enjoy your lunch, have a safe trip back, and thank you very much indeed. Thank you.